the meeting?
Yeah, it's 7:30, babe. Why? Well,
Good evening, everyone. This is Lori Charlton. It's February 6, 2024. Welcome to this regular meeting of the Board of Finance. I'll call the meeting to order and ask that we all please stand. Mr. Mottola, will you lead us in the Pledge of Allegiance? Okay, before we jump into our agenda, our board members will recall that our former colleague, Sheila Marmion, let us know last month that she would be resigning from the board. She agreed to be here tonight. I want to thank Ms. Marmion for being here and giving us an opportunity to honor her and her long record of service to the town. For those who don't know, prior to her service on the Board of Finance, Sheila served 2.5 terms on the RTM and also served as a selectman. And she's been a great colleague these past years. Sheila, I've enjoyed so much working with you, and you're a consistent, thoughtful, valuable voice on the board. So thank you again for everything. Thank you for being here. I don't know if anyone else.
I'm sorry, I skipped over. No, Sheila, I think I've served with you the longest out of anybody on this board. And thank you for all the work and time you put into this. And thank you for your dedication to the town of Fairfield. I don't know, Lori, if you want to give her this plaque or if you want me to.
I can. I'm sorry, Jack, did you want to say anything?
Yes.
I just wanted to thank her for her time. I mean, as we all know, it's a labor of love and dedication to make it to these meetings and to hold to your convictions. And I think she deserves a lot of credit for that, holding to her convictions in the time she's had on the Board of Finance.
Thank you. All right. Well, we'll let your oldest friend present you with your plaque, and I'll take a picture if you don't mind. It's been such a pleasure to serve with all of you. And I'm going to miss you. I really am, because it's been so fun to be this engaged and involved in everything that's going on in Fairfield. I so appreciate the wisdom and experience and dedication of the board members. Really, truly a tribute to this town with all that you give. And I look forward to hearing about your successes in taking on some of the challenges to come. And Bill, you as well. I'm so excited for you and your administration. So best of luck to everybody, okay? Thank you very much. Okay, and I'm also very happy to welcome Shane Penley, who was appointed by the Board of Selectmen to fill Ms. Marmion's vacancy and was sworn in last week. Welcome, Mr. Penley. Would you like to say a few words?
Yes, thanks. I'm looking forward to working with all of you, and now I know I have something to work for.
Thank you. All right, so to the members of the public who've dialed in or joined us on WebEx tonight, you are muted and will not be heard by board members, and there will be no live public comment until called for during the meeting. Public comment pertinent to items 6 and 7, 2 voting items, is welcome and will be called for before those items are heard. If you're on the WebEx and wish to provide public comment, please include your name in the chat with an indication that you'd like to speak now or at any time before those items are called. Members of the public are always encouraged to send their comments and questions in writing to the board at bof@fairfieldct.org. And if you do so, please remember to include your name and address for the record as you would with live comment. So the agenda for tonight's meeting focuses on some broader matters around the town's financial status and outlook. Among other items, we'll have a presentation on the town's audit and the audited financial statements from our independent auditor for the most recent fiscal year end, ended June 30th, 2023. We'll have a presentation from our town's financial advisor who will walk us through some financial benchmarking for the town of Fairfield compared to other AAA-rated issuers in Connecticut. We will have an update from the administration on the town's 10-year capital plan and an updated debt waterfall, which projects out how that proposed capital spending would affect the town's bonding and debt service expense over the life of the borrowing. We also have an update on the status of projects funded through the federal grant the town received under the American Rescue Plan Act of 2021, otherwise known as ARPA, and a voting item requesting reallocation of some of that $25 million in ARPA funding among the various projects. Lastly, tonight, item 8 on tonight's agenda concerns the appointment of a clerk for this board, which is typically a vote we take up annually in May or June. We're doing this tonight because our former clerk and CFO of the town, Jared Schmidt, has recently resigned from both roles.
When was that, Lori, exactly?
I believe it was official a week or two ago. Mr. Gerber, would you like to update the board on the CFO situation?
Yes, hi, Bill Gerber, First Selectman. I don't remember the exact as of date of Jared Schmidt's resignation, but as of today, we have an interim CFO, and that is David Becker.
When was that decision made, and why wasn't the Board of Finance informed of it? The CFO is the clerk of the Board of Finance, for those that aren't aware.
Actually, the clerk is a separate role in the charter, and we'll take that nomination up later, but that is separate. It's not necessarily the chief financial officer, but Mr. Becker, I believe, has been appointed on an interim basis. So I don't know if you want to add to that.
I'm just trying to find out when this all happened, Larry, because as far as I know, no one on the Board of Finance was informed of any of these decisions.
Yeah, I just, it was after the last meeting, and so I was planning on, doing that tonight and making an announcement tonight.
Okay, thank you.
So he was still, I'm just confused on the timing. So he resigned after the last board meeting?
He did, yes.
Yes.
And when was Mr. Becker informed? And again, I'm just trying to figure out why no one on the Board of Finance was notified.
This morning, Mr. Becker was appointed.
Yeah, so we're being notified today, right now at this meeting. First to know. Ms. Ruggiero?
So don't you think we should have been notified, Madam Chair? I mean, we're the fiduciary responsibility for the town.
Jack, it happened today and we're being notified at tonight's meeting, so,
Okay, well, we weren't notified when it happened, were we?
There's no requirement for us to be notified. I think being notified the day of.
I think it's at the very least, it's a commonplace courtesy that we should have been given.
Okay, well, now we know. Ms. Ruggiero, do you have a comment?
Is it customary for us to see resumes or be involved in that process?
No, not tonight. Not in my experience. I don't think any of us were received resumes or were involved in any way in the selection of the last CFO. I can't speak to the process before that.
One comment quickly.
Yep.
We are going to post this job description hopefully before the end of the week. And, you know, we haven't done that yet. So we need an interim CFO to do some of these roles. And that would be not, I don't believe that would be something that I would have to run through. And I don't believe I have to run through you when we do hire a CFO, but we will be posting it.
Okay, thank you.
And who is that? So you're saying that's David Becker right now, Lori? Is that my understanding?
That's he's filling in as interim CFO until a permanent CFO is hired.
And there's no vote on that? That's just a decree from the King of Fairfield, Connecticut, is that right?
Yeah, I'm
Can I get Mr. Michelle speak? Sure.
The charter says the first select person appoints the CFO. He has the authority. It's not run by the Board of Finance. The only thing we vote on is who's going to be our clerk.
Well, and what qualifications are those, John? Is it anybody? Can anybody walk in off the street? and be the town of Fairfield?
Jesus Christ. You have no authority or responsibility in the appointment of the CFO, period.
I didn't say I did. I'm asking what qualifications the current.
You charter.
I'm gonna put this on. This is not an item on the agenda.
Fairfield is.
On the board as a courtesy,
All you want, but I'm not gonna stop talking.
Mr.
until you-
Testani, we had no notification or input to the last CFO. I don't remember any debate about that. That's not the way it works. The first select woman appointed the last CFO without any consultation to this board or anyone else, as was.
We knew the former CFO's qualifications. All I'm asking
Yeah,
is.
and I'm sure we'll have the new CFO's qualifications once that person is appointed.
What are they?
Okay, we don't have the job is being posted. Okay, I'm moving on to item 3, to hear an update from the town's external auditor on the annual comprehensive financial report. So backup materials for this item are posted online. The relevant materials begin on page 1 with an internal control report, followed by a PowerPoint presentation beginning on page 4. The annual comprehensive financial report, ACFR for short, for the year ended June 30th, 2023, begins on page 43. This was previously sent to board members. I'd like to welcome Mr. Joe Santafonte, the audit partner representing his firm PKF O'Connor Davies. They are our auditors, and he is responsible for the town of Fairfield audit. I think Ms. C is going to put the presentation up on the screen for us, so I'll let her do that and then turn this over to Mr. Santafonte.
I have to keep it held. Okay. All right. I don't know if I'm this coordinated. Okay.
You want me to?
That's all right. But you can do the actual PowerPoint or?
Yeah, I was gonna,
Okay.
hold it.
No. I'm going to use the PowerPoint to kind of walk through these documents. So we have the financial statements is the bigger document, the federal and state single audit, the smaller document, and then there should be 2 letters. One is the recommendations and the other is our required communication to those charged in governance. All right, so we're going to talk about the highlights. Again, those couple of reports that I just mentioned, the recommendations, the required communications, and then future considerations, what GASB is up to. So as far as the highlights, the real highlight this year that's different from last year was GASB 96 for software subscriptions was effective and implemented. This is very similar to GASB 87, which was leases, which was effective last year. Basically, the accounting is exactly the same as for leases. I'm not sure why they made them 2 standards, but they are 2 standards. So this basically is an intangible right to use software is recorded as an asset. And then the liability for what you have to pay for the use of that asset over the term. So it's required updating the financials, updating your accounting policies for capital assets and liabilities. And then there was a prior period adjustment, but it did not affect equity. It only affects the government-wide, those top statements, Exhibit A. All right. So the financial statement highlights, reference MD&A. This is a good executive summary of what happened during the year, what the results were as compared to prior year. So it talks about your general fund net change in operations was the 2,181,000. Fund balance percentage was maintained. Talks about your budget variances and additional appropriations that were done during the year. Talks about significant capital asset activity, construction, equipment purchases, and then your long-term liabilities, which now includes the software subscriptions. So again, I recommend everyone kind of read that. It gives you a good perspective as far as what happened during the year and what were the changes as compared to prior year. So now looking at general fund, which is exhibits C and D in the report, pages 26 and 28. Your unassigned fund balance at year end was at 41,062,000. Your total fund balance was 46,505. If you do look at exhibit C, you'll see that there's a non-spendable piece, which is new this year. And that relates to some accounting for your leases. So it's non-spendable just due to timing of revenue recognition. So your fund balance percentage ended at 11.76 and as compared to prior year, 11.75. So basically it was maintained at the level of the prior year. And as we just talked about, the net change in fund balance was 2,181,000. The next slide is just a chart of your total fund balance, just showing, where it's been over the last 11 years. So you have a nice trend of reasonable increases every year. And again, that's on the total. So as far as where the 2,181,000 came from, revenues and other financing sources were in excess of budget of $19,000. And basically that was due to the revenue additional appropriations that were transferred to the capital non-recurring. So property taxes were under budget, the 199, governmental revenues were above budget by 89,000. Charges of services were a net of 13 positive. Most of the increase there was due to rent. So the lease standard, the entry for that. And then other was 96,000. So the expenditure side is really where your fund balance increase came from. The expenditures were under budget by the 1,876,000. Some of the larger departments, if you're looking at on pages 104 through 106, administrative in general was underspent by 239,000. 87,000 was conservation commission, and town clerk was about 36,000. Contingency was underspent by the 474. Finance was underspent due to assessor was underspent about 112,000, and unemployment 114,000. And cultural recreation was underspent 146, and 86,000 of that was for libraries, and 59,000 was for beach lifeguards. So the revenue variance that is really what your increase in fund balance was.
Quick question, and this is probably for Caitlin. So the property taxes being under, was that delinquent property taxes that weren't? Okay.
Yeah, it was the prior year, just like it is this year too as well.
Okay. Thank you.
All right, so next is the parking authority. So there's an increase in that position of 120,000 as compared to last year was 32. That was driven basically by increase in parking revenues of 209,000 as compared to the prior year. The lease payable at year end was the 3,132,000. Again, that was a standard that was implemented last year, so the liability is not recorded for the lease payments. And the unrestricted net position at year end was $1,446,000. So financially, the parking authority is in good shape. All right, internal service funds. So your current ratio increased a little bit this year. So your target is 1, you're well over the 1. Charges for services were up about 533,000. And then claims were down 1.1 million, which basically created your change in net position of the 1,438,000 and ending net position of the 7,470,000.
Sorry, do you mind if I, so the decrease in claims, which category of claims were down year over year? Was that, do you know, was that medical? Was it workers' comp? Was it medical?
I think it was medical, a little workers' comp, and a little bit of the legal claims.
Okay. Yeah, because we've had, I believe, 2 years in a row now of not funding that risk management number, and our fund balance has climbed. So that's a good thing. Okay, thank you.
All right, so next, pension and OPEB. The first slide is the employees plan. So basically in 23, your change in fair value came back, not all the way, but part of the way is compared to last year was down 30 million. This year you had a positive of the 12,472. So your change in that position basically was the $8 million. The benefits as a percentage in that position went up slightly, and the funded ratio went up slightly. So even though the fair value came back, it didn't come back all the way, at least as of June of 23. But 83% is still a good funding percentage. So police and fire, similar. Change in fair value was up to 11,476,000, so recovered almost half of the decrease last year. The net position up $8.7 million. The benefits as a percentage did increase a little bit more, 0.27%. Again, just a slight increase in your funded ratio. So that's right at the 80%, which is kind of what you're looking, is considered a well-funded plan. OPEB for the employee plan, again, similar numbers due to the market. Your benefits for the employee plan was up 1.47% as compared to prior year, and your funded percentage went up 13%. That was driven basically through the actuarial calculation of liability, went down about $6.3 million. If you look at page 116, it'll give you the details, but although there was a change in the discount rate, it didn't impact the employee plan so much. But when we look at police, it did have a significant impact on there. So 60% is a high percentage as compared to other towns. So you're making a lot of progress on.
Yeah, that's. I didn't think we'd be seeing 60% in OPEB anytime soon. That's.
Yeah, so hopefully that trend continues for that one. Police, again, the benefit ratio up 0.73%, so it's driving part of this. That was a 3.8% increase, 45% on that one. Again, in that case, the liability, looking at page 117, went up almost 5.7 million due to change in assumptions, which was just the discount rate was reduced from 7 to 6.9. And that drove that only because of the liability is much higher. So the impact of that discount rate change was more significant on the police and fire plan than it was on the town.
And can you just remind us, so these funded ratios, these are based on year-end market value. This is not based on the smoothed value of the assets, right? This is just based on June 30, 2023.
Yeah,
Right. Okay.
Exactly.
Yeah. So this doesn't Okay, so the effect on our ADEC for next year will be muted because they'll be using the smoothed value, right? Okay, yeah.
Right, they got rid of that 5-year smoothing comparison, but they still use it, and that creates those deferred inflows and outflows.
Right.
Effectively, it's still there for your calculation.
Yes.
So your budget doesn't jump
Got it.
crazy.
Thank you.
All right, long-term liabilities, the new one, software subscription payable, we mentioned, the new accounting policy note. So in the financial statements, if you look at the long-term debt note, it's included as long-term debt, and it's showing as part of your long-term debt on Exhibit A, the top statements, the government-wide statements. Again, the new disclosures, capital assets, subscription payable is about 2.8 million. At June 30, and again, we mentioned the prior period adjustment has no impact on beginning equity, just as your asset and liability. So looking at the next page is a little bit more detail on that liability. So the biggest liability in most towns is the police body cam software and storage. So that's 2.1 out of your 2.8. And again, that's pretty common because those are long-term plans, and depending on the size of the police department, they're larger numbers. And then these are a few of the other ones. Digital learning, the last two are education related. So some of the digital learning is multi-year agreements. And see a lot of education side doing that because a lot of these vendors will freeze the price if you lock in for 3 years or 5 years. 3 is the most common.
So basically, this new accounting policy is just putting these software agreements on the balance sheet. On both sides, right?
On both sides, and then because of the present value calculation, they don't move the same, so depreciation and the amortization of liability move a little bit differently, but yeah, that's the only real impact.
And what was the overall impact on our, was the bottom line impact from this? I mean, roughly, it was not significant, was it?
It's only going to be on the top line, so it doesn't affect in the back, it doesn't affect your budget or that. Like
Right.
leases did because they had the receivable side, there's no
Okay.
receivable side to this. But for this, it's just like any other long-term debt and capital asset. It doesn't really affect your budget or your general fund operations. It's just
Okay.
on the government-wide statements.
But if you're amortizing your asset and then your present value and your liability a little bit differently, that differential flows through somehow, right? I was just wondering what the impact of that was.
Yeah. It flows through the top statements. So capital assets. So 852,000 in depreciation on page 59.
Okay.
And then the liability change was 812.
Okay, so
It's not far off.
it was
but-
de minimis. Okay,
Yep.
thank you for that.
Okay. Okay, the environmental liability, last year was the 14.9 million. This year was revised estimates, 13.8 million. So a net change of a decrease of the $1.1 million. And these estimates came straight from the engineering firm. And then, I don't know if I put that on here, but the town has more than $13 million put away towards to fund that liability. So you're basically have fully funded it and you have a cushion in case estimates change.
We increased Penfield, I think, yeah, okay. Now we're about even, but okay, yeah. All right,
All right, federal and state single audit. So I'm gonna give you a little bit of background on what these are and the requirements and some of the testing that we do. So in addition, even if we didn't have a single audit, we are auditing in accordance with government auditing standards, which requires a report on internal control and compliance. And that's again on the small report. Those are pages 1 and 2. So this is general compliance versus compliance with specific programs. So compliance with the charter, federal regulations, state statutes, those type of things, not grant specific. So if there was something material that the town violated, that report would have a finding saying there's a compliance issue because you didn't submit any withholding tax or whatever it was, but it would have to be a material non-compliance. I mean, the town has no findings or no internal control findings or no compliance findings related to this, but we are just giving a report on general compliance. And then specifically for federal single audit. So the requirements are if the town expends $750,000 in federal monies, they're subject to a federal single audit. And then that will change if you spend over 25 million. I think you're at 18 million this year, but then it's indexed up at 3%. But the town's threshold is at 750. So as part of the approach, the requirements are we have to look at, they call them type A, if it's 750 or more, or type B, if it's 25% of that, the 187. The B programs get evaluated from a risk assessment standpoint. So once A's are tested, if they're evaluated low risk, we would substitute a high risk B, as they call them. And that just gets more coverage on different programs. So the required coverage for a low risk auditee is 20%, which is your situation. That's identified on page 10 of the report. And if you're a high risk auditee, we have to test 40% of federal expenditures. Again, this is on the expenditure side versus the revenue side. So it gets confusing sometimes. So you got 25 million ARPA, but it doesn't count for this purpose until you spend it. So revenue doesn't drive this, it's expenditures. So high risk auditee, if you had internal control or compliance findings or late filing of the report, that would cause a problem. So they're looking at these rules now and it's expected to go up in the near future. It may go up in 2024. I heard rumors about it going up, major program or threshold going up to $1 million, but that hasn't been officially announced.
Can I ask a question, Joe? So
Sure.
we were a low risk auditee, you said, right? Okay.
Correct.
So that means, do you test 20% of total dollars in each grant that's under audit or?
Total.
Total. So 20% of, so if there were 5 grants that spent 750 or more, you'd have to test 20% of the aggregate amount, right?
That's the minimum. That's the
A minimum. Okay.
So depending on how we evaluate the programs, it may come out to be more than 20%.
Okay.
And the timing of testing and that whole risk assessment process may force us to test more than 20%, but that's the minimum.
And your testing is just picking, vouchers and validating that the expenses were spent appropriately and recorded appropriately. Is that what you do? And in accordance with the grant?
Right. Allowable cost is the biggest item that we test, but there are other compliance factors depending on the compliance supplement. So that the federal government issues a supplement, say for this grant, this is what we think is important. So some of the other things are listed on the bottom of that slide there: eligibility, procurement, prevailing wages, reporting. There's level of effort calculations. It just depends on the grant and what the feds decide is critical for that particular grant. Then we have to test all of those compliance. And I think there's like 10 of them, but we only have to test 6. They're only allowed to pick the 6 most critical, and those are the ones that we test in addition to allowable costs. But that's the biggest thing, the transaction, so invoices, payroll, that type of thing. We tend to do dual purpose testing on that because we have to test internal controls and compliance both. So there's no, assuming there's no controls and no testing, we were required to test controls for federal single audit purposes.
So if you had 5 different grants, you might have 5 different types of testing that you had to do on each depending on the grant requirements and what's important for those grants.
Correct.
Got it. Okay.
Yep. So again, there is that risk assessment process that we looked at. So there's things that, like I said, prior findings, whether the program was tested in the last 2 years, if it's designated higher risk, which you have a couple of, we'll talk about when we see what we actually did test. So that we may be able to, if it's a low risk A, we could throw that out and substitute a high risk B, again, knowing we still have to hit that 20% coverage, and B's again start at 187.5. Again, then we talked about the compliance things. It just depends on what that grant, specifically what the compliance supplement says to tests. So state single audit is modeled on the federal single audit. Not all states have state single audit. Connecticut's one of the handful that do. The difference is the threshold. So major programs for state are $100,000 up to $1 million in expenditures. Goes up to being 3% of your actual expenditures. So non-major programs, again, the type B is 25,000 versus the 187.5. It's been 25,000 since 1991. So us auditors have asked for that to be indexed, but it hasn't happened. So it's a pretty low threshold. But again, the coverage for state is 50% of the non-exempt. And if we look at, when we look at the state schedule, they have certain programs like ECS is an exempt program. We don't test that. That's your biggest grant. So the non-exempt, we have to test 50% of those programs using the same methodology, the same risk assessment process, looking at A's and B's, and the same dual purpose testing, internal controls, and compliance testing. And again, the state has their own compliance supplement that tells us for this grant, this is what's important. It's, again, the examples being the eligibility, the matching, the reporting, in addition to the allowable cost, or sometimes there's recalculation of information sent to the state, those type of things. So that's kind of the background of the types of things that we do. So the next slide is starting in your actual results of the audit this year. So for federal single audit, no findings or question costs, unmodified opinion on compliance. Again, that's a different, the compliance on the programs that we tested starts on page 3. The total expended last year was the 18.4 million. ARPA was 6 million of that number. So that's pre-ARPA. And these are the 5 programs that we did test. So that's your block grant program that hasn't been major in multiple years, and the spending kind of crossed the threshold this year. So in this case, we tested way more than 20% because these 5 grants are going to be higher. So highway planning construction, that's a grant usually used for bridges, that type of thing. So since they are A programs, not low risk, we have to test them. So 20% again, it's just the minimum, but we got to go through these calculations. And then designated as higher risk, the ARPA money and the ESSER money at the education side, both are designated as higher risk. So for the most part, we have to test those programs every year. ESSER will be fading away, but ARPA, we got at least 1 more year or 2 more years to December 24 on those. So that kind of, again, drives what our testing. And then disaster, the FEMA grant, that was a type B program that we did test this year.
And what did we spend FEMA money on this past year?
This was the Board of Ed reimbursement, but because we weren't aware that was FEMA money when it was spent, because it came in, we had to then look back and test it.
So that came in at the end of the last, that was for the PPE and all that? Yeah.
Right.
Okay,
Right.
gotcha.
It was kind of delayed as far as when that was received.
Yeah.
State single audit starts on page 11, a smaller document. And no findings or question costs, unmodified opinion on compliance, total state expenditures of almost $13 million. The programs we tested were open choice, Medicaid, the 911 communications fund, and this tiered pilot grant, which used to be the state-owned property. Now it's called tiered pilot. It's just a little bit different. And they added 2 other pieces, this MRSA pilot and municipal revenue sharing grant. They attached it to that grant. So it becomes a bigger number. All the compliance really is the state-owned property. It's the first one. Okay.
Boy, MRSA is a terrible name for a grant.
Yeah. You get another one that's called that too. They call it municipal grants and aid, but I don't know how they came up with that. All right, so recommendations, we did have 3 recommendations here. The education grants fund, the year-end close process needs to be include looking to make sure the recording accounts receivable and unearned revenue. That will be modified a little bit in 24 because most education grants in 24 are now reimbursement. It used to be able to advance and request, but that kind of went away. So it'll be mostly just the accounts receivable, but that needs to be part of the close process to book the receivable for any monies that were spent that weren't received at year end. Education self-insurance fund, this fund is still open and the activity is just being transferred from the budget through this fund. So it's a recommendation to kind of close that fund to make sure that all the activities in the general fund, and because they're not self-insured, it's not reported, it can't be reported as a self-insurance fund. So I think it's just left over. They always transferred money and paid out of that other fund, but now they just should be just paying directly out of the budget because they're in a fully insured plan.
Yeah, when I read that your report, I was a little bit confused by this. So is there a balance in that fund?
There was a small balance.
Okay.
But so I think part of it was an interfund, and then that's how it kind of came to my attention because the interfund was $2.9 million, and we have to balance interfunds. But I wasn't even aware this fund was still functioning because I knew we were fully insured. So there's a small.
Is this in the CAF? Like where is this fund? Where does it sit?
It doesn't sit anywhere.
I don't understand that.
So conceptually, all they're doing is moving money out of the budget and putting it into this fund and then paying the bill.
It's got a zero balance.
I think there was a small balance, like of $8,000 that are receivable or something.
So when you say they move money out, they record that as an expense in the general fund.
In the budget.
Okay, but they're basically transferring it into a fund that was sort of off the books, if you will.
Yeah, it was off, right. It wasn't, when they were self-insured, it was included with all the internal service. But once they went fully insured, I wasn't even aware that the fund was active anymore.
So the fund has been active, but it hasn't been captured in the financials, but you said the balance is small.
Are very small.
Okay, but it sounds like it was just an extra step in the accounting that they were doing.
Yes, and just something didn't go right and there were bigger balances, then this is going to avoid that. And I talked to the Board of Ed about that. They just need to kind of do the entries and zero this out.
Got it.
And just pay the bills directly out of the budget.
Okay.
And excess cost grant reporting, just as part of our testing, it's just recommending some better documentation and review by the finance department to make sure the numbers that are being reported to the state are correct. And this just generates your excess cost grant. All right, acquired communications. So that's one of the other letters. In the letter, it talks about estimates, what the significant estimates are, and then we do audit those and we do test those. New accounting policies, which was GASB 96. We talked about was added to your footnotes. Disclosures are neutral and consistent. We are independent of the town. And then there wasn't a past adjustment, which was attached to the letter for the group payable or contracts payable, which is similar to the prior year.
And what was that amount?
$343,000.
So we accrued basically by, okay.
Correct. All right. The last item is just what's effective next year, or is not even next year. What GASB's working on is GASB 101 for compensated absences is the update of GASB 16. So it's been a while, but GASB has a policy of revisiting standards after a certain period of time. So really it's just a clarification to get consistency in the calculation, because in practice, based upon the research, the calculations weren't consistent. It has to do with services already rendered. It must accumulate or vest. And the The thing that changed, it's a little bit more, less precise, is that more likely than not will be used for time offered to be paid in cash. So they're not, there's always a probability factor. Now they're using more likely than not. So that's a pretty broad way to estimate something.
And what does this cover other than vacation?
If sick time does vest,
Vacation, sick?
on the education side especially, but it would cover that. So basically, the current process, we look at if it vests after 20 years and someone's been there 5 years, we would assign a probability that they may make it to 20 years. So you can't just say all or nothing, and that's kind of what the standard is saying. So there has to be some estimate that some people will make 20 years. Of course, it's a lot different now than it was 30 years ago when I started doing these calculations, because I don't think people stay as long as they used to. But we asked HR if they have any data for this, but most HR departments are not tracking these type of things. So we,
Does our sick pay accumulate, like, I mean, on vacation, we have some sort of use it or lose it after a period of time, right? But what about sick pay?
So every contract is different.
Yeah, of course.
So that's for vacation. Sick is, there's a bank, and again, I think every contract's different there too. And then we have comp time. The things that are paid are vacation and really comp. We don't get paid if we leave, if we have sick in the bank.
Okay,
on the town side, but education, those contracts are a lot different, and generally, a lot of education departments have started taking that out, but years ago that was common, accumulating up to 120 days.
so when we implement this on the Board of Ed side, it could cause us to put up a big liability for accrued sick pay or something? Is that what the impact's going to be?
Well, it's already there because I think I'm kind of, my approach is to record an estimate. It actually may go down if this whole more likely than not is a lot broader than
Right.
a probability estimate.
51%, right?
Right,
Yeah,
right.
okay, got it. Okay.
All right. And that's the end. If you happen to answer any.
Thank you.
Questions?
Questions from the board? Mr. Stark?
Yeah, and please, I'm going to beg your patience in advance because this is the one time a year where we get the municipal accounting guru here to answer questions. I've never understood deferred outflow of resources because there's no similar concept in corporate accounting. And I see that it's basically all pension and OPEB related. Can you conceptually explain why in municipal accounting the pension liability has to be, and the assets have to be reported that way? I hope I'm making sense with the question.
So other than, I'm not sure why GASB decided they wanted to make two new categories. So this is just GASB philosophy. I guess so I don't know if it makes sense, but it's the result of that 5-year smoothing for pension and OPEB. So basically these deferred outflows, depending on investments, if they went way up, you're going to defer some of that and then amortize it in, and same if it went way down, and it's all going to get netted out. So it's just a way to smooth the operations. So your pension expense isn't 20 million this year, negative 20 million next year. That's what the attempt is to smooth those numbers. And then from a actuarial standpoint, when they calculate your required contribution, they're considering the deferred inflows and outflows as part of that. So you're getting your contribution. If you have a bad year in investments, they're not recommending your contribution go up by 5 million to cover the bad year in investments. And so it's kind of a, government, and although those are accrual statements, is more about available and that type of thing. And that's the issue with the leases, is because we have a deferred inflow because we're booking a receivable for $5 million, but you're going to get it over 5 years. So you tell everyone that you have a receivable for 5 million, but 4 million is deferred because you're not going to get it in the current year. So that affects the back statements. So that's the available concept. It's not available for the town to spend right now.
Related question. And if anyone wants to follow along, it's on page 24 of the annual report. You can't keyword search the backup because that portion is a scan. The net position is reflected as a net investment in capital assets, and I'm conceptually having a hard time understanding that too, because the net position is really all of our assets minus all of our liabilities, and some of those assets are not capital in nature. So why is the net position expressed only in capital assets?
Well, it's actually expressed in all those categories, and that's just the largest one. And what that's trying to tell you again is that's not available because that's your capital assets minus the liabilities to acquire them. And then some other things, retainage and accounts payable. So basically what they're trying to do is get down to this unrestricted number, the 66.8 million is what's unrestricted could you use? Again, and these are the accrual-based statements, which towns do not use to manage because they're accrual, and then some of this information doesn't make sense from what you need to operate the town. That's the budgetary, the statements in the back. So these are the accrual statements, which was the attempt by GASB to make them look more like private sector. So we have this basis as accrual, and then starting on Exhibit C and D are modified accrual, which is the government basis of accounting, which is so there is a definition in the MD&A, but basically it's if you take your capital assets on the first page of that minus your long-term liabilities, your bonds, your leases, it gives you that number. And again, the concept is that's not available to spend because it's roads, it's bridges, it's the buildings, that type of thing. So that's what they're trying to accomplish with that number, is to tell you that it's part of equity, but it's not really available to do anything with.
So basically, if you look at the asset side of the balance sheet, you look at your total capital assets, which is buildings, improvements, land, all that stuff, that's 549 million. So that's the asset side, and then the liability side is the long-term debt, pretty much. I mean, there's probably a few other categories mixed in there, Kevin, but I think those would be the big pieces that net out to the 336.
Yeah, I was reading it wrong.
Yeah.
Look at it again.
Yeah, it's an odd way to present it, but yeah, normally you'd see like retained earnings or something, right? Yeah, it's.
One last one for me. This is like a question that I should ask like a 4-year-old because I should have asked it earlier. On the 17 million-ish interest liability on the pension, that is what, like the accrual on the actual underlying contributions from town employees? Is that what that is? The interest component of the liability? I'm.
Are you referring to a footnote? Do you want to point us?
It's in the pension.
What page?
Uh,
Or maybe if there's a hard copy page.
Page 78, for example, the employee's retirement plan, Exhibit K. If you look in the column A, balance at July 1, 2022, 263, 767, and then you see an interest component. I just want to understand this better because I don't do pension accounting all day either.
Yeah, that's just the interest that's accrued on the liability for the current year, because the liability is present valued. So every year as the you accrued interest. So that's the interest cost.
Okay. Does that need any other clarification, or is that the right answer?
No, that's what it is, and the actuary calculates that, so that's
Okay.
we audit assumptions behind that, but that's an actuarial calculation,
Okay.
Based upon your discount rate, because you didn't fully fund the liability as loaded. So,
Okay. Thank you for Muni 101.
Thank you. Mr. Curley.
Thank you, Madam Chair, and thank you for being here. Thanks for taking us through this. I was focused on the general fund, and I'm looking at pages 17 and 18 in the ACFR. Two questions. Can you just help explain the difference between the $41 million balance in the general fund that's unassigned versus the 46,000,005 that's referenced? What is that $5.5 million difference?
I'm not sure.
So he's asking about total fund balance versus unassigned fund balance, the difference.
So difference is going to basically be the timing of encumbrances. So the 41 million counts encumbrances, and the gap on Exhibit C does not account encumbrances until you pay them. So that's one of the government-specific items. So we didn't reconcile fund balance, but encumbrances at year end were $4.7 million. So that's going to be shown. If I'm looking at page 107. So that's going to be an expenditure out of the 41 million, but not out of the gap number.
Okay, that's helpful. Thank you. And then on page 17 of the ACFR, bottom of page 17, where it's talking about describing the general fund, it makes reference to the table on the subsequent page. And I'm just trying to reconcile to the 41,062 for the general fund balance, because I'm seeing at the bottom of that schedule on page 18, 41,685, and I'm guessing it's operator error as I read this, but I'm just trying to understand that.
Well, that's the same answer. Encumbrances, the timing of encumbrances is gonna, because this is the budgetary statement versus on Exhibit C or Exhibit D is the gap statement. So that should be the difference. I'd have to look, but that it's the same $4 million. So this is going to be $4 million lower because the timing of encumbrances.
Maybe I'm misreading this, or I'm looking at the difference in the actual column on page 18, the very bottom.
I think I know what you're asking. Maybe I can, are you saying, Joe, that the 41,062 is unassigned gap basis and the 41,685 is budget basis?
Yeah, well, the difference might, again, when I was doing the math, the 742, which is the non-spendable related to leases. So that's a gap only
Yes, okay.
item.
Yeah.
So I'd have to do that math and see if you take the 41,062 minus the 742 on page 26. I don't know if that gives you the number.
It doesn't. It's close, but I'm looking at bottom of page 18. I'm looking at 41,685. Do you have that number? Okay.
No, I know what you're trying to do. So if it's not that difference, I would have to look at my board paper.
It's fine. I'm good. Thank you.
But just to be clear, though, those two numbers are on two different bases of accounting, right? One is GAAP, one is budget.
Correct.
Right, so you wouldn't have the lease piece in the budget, therefore it would be higher, the fund balance.
Right.
Okay. Yeah, it's weird because it's, even though the 4162 is GAAP, it's unassigned in GAAP, which unassigned in GAAP still takes encumbrances out because encumbrances would be a total fund balance, but they would be assigned, right? So that's the, yeah. Other questions from the board? All right. Well, Joe, thank you for being here and for all the work you do for the town. You had mentioned before, I think some of the board members might remember that we had a tough time at our audit last year. It got delayed. We had to have an extension. Happy to see it got filed on time this year. And you said 21% of towns in Connecticut actually get done on time or something like that?
Right.
Yeah.
Yep.
So kudos to Caitlin and the finance team, and thank you for all the work that you do. And it was good to see you. Talk to you soon. All right.
Yeah, good night.
All right, so we're going to move on to item 4 to hear a presentation from the town's financial advisor, Phoenix Advisors. So the materials for this item begin on page 207 of the posted backup. And we have Matt Spurgill here from Phoenix, who has served the town for many years in all matters related to our debt financing. Welcome, Mr. Spurgill. Turn it over to you.
Thank you very much, Madam Chair, and for members of the Board of Finance, a lot of familiar faces. It's nice to see you tonight, and some new faces as well. This has kind of been the annual, what's become an annual update, sort of to give a snapshot of the town's credit profile, specifically as it relates to versus the other Moody's AAAs in the state of Connecticut. So this is one piece of the puzzle that goes into the credit. Obviously, trends are important. There's other qualitative measures and things like that are really something that you can't put in a chart. But this really will cover, the vast majority of the metrics that get used by all the rating agencies. They all do it a little differently, but this gives you a really good snapshot. And to see it relative to your peers, it's very helpful. So I'll just dive right in, and if there's questions as we move along, I'll try not to take too much time. And really, it's graphical, so the visualization is pretty straightforward. So let's move on just to the next slide here, and you can see the other communities in the list. So however many that is, 12 or 15. You have the other ratings there, S&P and Fitch. Not all the issuers get all 3 ratings, so that explains that. One that is off the list is West Hartford, that happened recently. So they're down to the AA1 category. Of course, for those of you who aren't as familiar with this, AAA is the highest rating. Then from there goes AA, single A. Within the AA category, there's a 1, 2, or 3 for Moody's, a plus, blank, minus for Fitch and S&P. So we're at the top of the food chain here. And that's something that we want to maintain, as I think we'd all agree. And just for purposes of the footnote there, all this data is pulled out of the Connecticut Municipal Fiscal Indicators, which is put out every year. But for Fairfield, it's updated with the data from the audit you just looked at. So anything I can pull out of that, I did. Otherwise, it was pulled out of the official statement we did with the most recent bond issue. So it's the most current town information that we could have in here. So once we go through this, you'll see Fairfield's going to be in yellow in every slide. And for the most part, with I think one exception, it's best to be more to the right. So we just try to keep it as easy as possible. And I'll reference the one that it didn't listen when I told it to do that. So we'll start with the first page is total fund balance. And, again, we don't want to get too bogged down in any one particular slide because it really is a comprehensive approach that these rating agencies take, so that if you're the lowest in one or the highest in the other, it doesn't mean you're downgrade material or you should be in a quadruple A situation, which doesn't exist. But it's just a nice snapshot to see sort of where everything falls and to know the relative strengths and maybe some of the relative weaknesses moving forward. So you can see here, again, total fund balance. And Fairfield, it's second from the left. It's not, quite in the middle there. Obviously not one of the higher ones, but, not at the ultimate low. Again, with this, I referenced trends. And if you looked at the slide that Joe had put up on the screen of fund balance over the last 12 or 11 years, whatever it is, it's gone straight up. I mean, I recall the days where we were, lower, 4%, looking at negative outlooks and things of that nature. So considering where we came and where we are, much better, much stronger. And I'll, to the extent that we hit a slide or a topic or a particular criteria that the rating agency specifically referenced, as either a strength or a weakness, I'll bring that into the conversation here too. And I'll say that obviously we're below the median, the AAA Connecticut median. We're way below the national median, which is closer to 25-30%, which is because there's different revenues. So there's a million reasons why that is, but in Connecticut, we're on the lower side. The only thing that they've really referenced at this point with respect to your fund balance is deterioration of the fund balance could cause some credit weakness moving forward. Not to say it's low and you're on the brink of downgrade or anything like that. So we're in very firm footing with respect to this, even though it's on, the lower range of this. And then we'll go to the next page and then we'll just show the unassigned as well. So you can see, we moved over one notch. But again, right in the mix. If we were, 5% and way down near the bottom or something of that nature, then that would obviously be a red flag. So.
Is it okay if we ask questions as we go?
Just,
So we're to the left here, but obviously this is among our AAA peers. Do you have a sense of what this looks like for all municipalities across Connecticut?
I do. Interestingly enough, it's not as if so this is the unassigned slide. AAA median is 14%. There's really no linear relationship to say, well, 14 is AAA, so 11% is for the AA's and 8% is for the single. It's almost opposite that in a way, because the fact that we're AAA isn't just have to do with your fund balance. It has to do with your wealth, your grand list, all these other factors, management, and things of that nature. So I think that the actual Connecticut median for unassigned fund balance is probably a little higher than 14%. I want to say it's like maybe 15 and a half. No, that's not this, again, sort of counterintuitive, but that's about where that would fall.
Okay, interesting. Go ahead.
I don't have, hey, Lori, I'm sorry, this is Jack Testani. I don't have the last year's evaluation in front of me. I'm just curious, do any of these indications for Fairfield change materially from last year at all?
I don't believe so. I would say like the fund balance percentage changed, it pretty much stayed the same. You guys are good at that. The debt probably went up a little bit with the issue, maybe, but nothing glaring that stood out. Can put it that way.
That's my question.
And that's pretty much probably the same for most of the issuers as well. From one year to the next, a lot of these kind of stay roughly in the same ballpark.
And I'm just curious, back on the previous slide, or maybe it was the second one before, on the different credit rating agencies, I noticed that Fairfield is one of the few that Fitch rates. I'm just curious why that is. Do they not rate the others? Do the others not qualify in their mind as a AAA? I just wondered.
I put this up here just for full disclosure, but if all these issuers applied for all the ratings, they would all be AAA across the board.
Okay, gotcha. Okay, very good. Okay, thank you.
You're welcome.
Okay, Mr. Curley?
Yeah, thank you, Madam Chair. Just in terms of convention, and as we review our fund balance, we often refer to it, express it as a percent of operating expenditures. This slide is as a percent of revenues. Is percent of revenues a more typical convention? Should we be thinking about this differently?
I think the way you think about it is fine, because most towns think of it, first of all, typically as fund balance June 30th versus the next year's budget basis, this fund balance, whereas all this is GAAP A, which makes it completely different than what you guys actually budget to. And some rating agencies like use revenues, the other use expenditures, and there's also the caveat that, like S&P, for instance, looks more specifically at available fund balance versus unassigned fund balance, which just includes assigned to the equation. So there's a million different nuancy type things. So what you're doing is fine. And I don't think anyone really works their policies and things to the GAAP number that includes the state TRB, for the pensions and all that kind of stuff. So I think what you're doing is fine, as long as, you stay strong.
Thank you. Ms. Ruggiero?
Hi, you had mentioned, I think, that West Hartford came off the list. And that in order to have the AAA rating, there's a lot of different variables that go in there, management, revenue, the results on these different charts that we're looking at. Is there a warning, or how did West Hartford fall off? Was there a lot of triggers or things that people were well aware where they had a period of time to address the issues, or they just took the AAA?
Well, that's a very good question. In West Hartford's case, if we were to look at this slide, they would have been the furthest left. So they had typically the lowest fund balance. They had very high liabilities, and really what happened, and by that I mean their pension liabilities had been underfunded, vastly underfunded for many years. And they did a $350 million pension bond issue. So just to put that in context, like that was a big chunk of what happened. But I think they would have been okay. But in October, it was about a year ago-ish, I think it was 2 Novembers ago, Moody's basically changed the goalposts a little bit, like they tend to do for every decade or so. They'll change the criteria. S&P is doing it currently, where they say, well, and I'm just using as an example what S&P is doing now. One of their criteria is like, well, there was a 10% weight on debt and 30% on economy and blah, blah, blah. Now they're doing 20, 20, 20, 20, 20. So whenever they do that to 11,000 credits throughout the country and they run it through their database, there's always going to be like a handful that fall to the bottom, a handful that fall to the top based on that little tweak. And in Moody's case, like I said, about 14 months ago, one of the things they did, I think they put a little bit more weight on like cash liquidity and some liability things that they were very weak with typically and historically. And they also removed some of the benefit that the larger grand lists would give you. So we would have these conversations, 10 years ago, 20 years ago. And we'd be talking maybe with the town of Woodbridge, for instance. They say, oh, yeah, you're AAA, but your grand list is on the smaller side. It's like, it's all relative, you know what I mean? So, but that would come up in the call. So for a Fairfield or a Ridgefield with a larger grand list, oh, well, that's a big grand list, and it gives you credit strength, what have you. Well, they basically took that factor away, and that was one of Ridgefield's stronger factors. So they kind of made that less important. They put more of an emphasis on this liquidity situation with the liabilities, and it just teetered them, interestingly enough. So I don't work with West Hartford, but I obviously became very familiar with it because of the fact that they were in this list, and I wanted to find out what was going on. But we do work with Ridgefield, and Ridgefield was also on that list. Lower fund balance, in a larger grand list. And we were fortunate enough through working with them. So whenever there's a tweak to their criteria, they reach out to us first and kind of like let us know, okay, we're doing this, and here are a few of your issuers that are potentially vulnerable. And then there's a process over the next couple of months of a rating surveillance and an update to just make sure that if there's anything that they haven't seen, because they might not have been in the market for a year or two. So just to kind of get everybody updated. And fortunately, we were able to hang on for dear life for Ridgefield, and I think they're good now going forward. But unfortunately, West Hartford, they slid down a notch, which is never fun. Nobody ever wants to have that happen. Not the end of the world, but obviously, I'm sure they would have preferred to avoid it. So,
Do you know what the impact, or if we were, not that we're going to, if we were to drop down, but when you trigger, what's the percentage that the difference between because the AAA gives us the lowest borrowing rate for cost of money. So what is the difference between the two levels?
Currently, the spread between like a AAA and a high AA is probably 10 to 15 basis points, which isn't that monumental when you think about it. A 325 versus a 340. It's not that big of a deal, but then when you start layering on 20, 30, $40 million deals year after year after year, it adds up. And then, of course, credit spreads can widen and narrow, and that could even be higher, in a higher rate environment. And if we actually ran that, we could tell you like what that equated to in terms of dollars. But on those issue sizes, it would add up to something you'd rather probably want to avoid.
Thank you. Mr. Stark?
I have a good follow-up to that. I remember I asked you a couple of years ago if during periods of credit market volatility that spread would widen. And if it's still only 15, 20 bips, it's actually may not have. But Bloomberg's telling me something else, right? I'm looking at Fairfield 2033 maturity, and these things don't trade, right? This bond's traded 3 times in 4 months. So whether these levels are reliable, I don't know, but it shows it yielding 3.7 right now. And then I go to the West Hartford, similar maturity, and it shows 4.9. So I don't know. Does that seem like just a bad level to you? Or?
It just seems like apples and oranges to me, to be honest with you. So the way we look at it is when we bring a deal to market, when we're going to sell the bonds on next Thursday and say, if you're a AAA, we think you're going to be here. If you were AA, we think you would be here. And then we actually see the bids come in, and we see when bids come in for other deals like that day or the day before, or the day after, and then we can kind of extrapolate out. One thing I'll say, in this environment, even though rates have come up, which you would think, okay, if rates come up, typically, credit spreads could widen to some extent. The supply is so low for Connecticut issuers right now that the bids they're probably trading even closer than 10 basis points apart at this point.
Okay.
So when you're taking one maturity from this deal and another maturity from that deal, which you might be looking at a taxable West Hartford, if it's the pension deal, that's taxable. Whereas the tax exempt is the Fairfield deal, so that's just a possibility. But there's just a lot of different factors that really wouldn't kind of apples to apples that comparison.
Okay. Who are some of the other high AA's that we could use as a comparison? You got West Hartford and Ridgefield, right?
No, Ridgefield's still a AAA off the top of my head. I mean, there's like a Milford.
Okay. Stratford, right?
Trumbull, Stratford, no way.
Let's
no offense if anyone lives. I know,
Okay.
I like Stratford, but no.
Yeah.
Bristol, I believe, and there's Southington. There's a lot. I mean, I could send a list because off the top of my head,
That'd be great if you could, but that's a good start.
Yeah.
You touched on the other thing I wanted to ask. Is there any place we can watch real-time total supply in the market in Connecticut?
If you have access to the bond buyer, that's kind of where we see it. But even then, it's a visible supply, not really by state. I mean, in terms of primary market, it's like, okay, how many sales are this week? And sometimes there's none. And sometimes there's 2. That's about where we are at this point. It's just very, it's very light. So when a deal does come up, like we just did South Windsor 10 days ago or so, and they got, 12 or 13 bids, and they were like all right on top of each other. It was, and there's really nowhere you could find any of that information online unless you have access to the website that holds the bids. You might find the yields. You'd be able to find some of those deals trading in the market, but the actual sale that we have it's on a website called Parity, which is an S&P product now. It used to be TM3. That's where you can actually see the TIC, which is what we award your bid on. The lowest true interest cost, which is like an average of all the rates, present valued, per the notice of sale that bond counsel puts together. That's the criteria. And then we award to the lowest true interest cost. And I think that the South Windsor was like a 327. Second place was a 327.2. And it was a 320. So, super tight, very successful sale. So
That's super helpful. Thank you.
Thank you very much. Mr. Gerber, did you have a?
Just quick question. A town that's at 23% fund balance, or maybe closer to 20% of unsigned general fund balance as a percent of revenues, like conceptually, why would they want to be that high? Is it because they're deficient in other measures, or they just have money to?
It very well could be if part of the strategy was to get that AAA rating to begin with. If a town is at that AA category level or anywhere on the rating spectrum, fund balance is one of the things that you have the most control over on a year-to-year basis. So they say, all right, well, what do we have to do to get AAA? We have all our policies adopted. The grand list is growing. Income is what it is. Housing values, which are all things you really have very little control over on any given year. But if you are super conservative with your budgeting and you say, listen, we want to get that AAA or we want to get that AA plus, and you go from, an 8% level to 14, to 17 the next year, there's a very good chance, if everything else is being equal, that you're going to get upgraded. And a lot of towns will do that. Now, if you look at this screen, I mean, I can't, let me just take a look at my printout copy. But, you know, between, you know, Madison and Weston and New Canaan and those type of towns are AAA, whether their fund balance is 16 or whether it's 10 or 11, I mean, they're going to be. Now, a town like Norwalk, that does have some other challenges from a demographic perspective, or even a Glastonbury that doesn't have quite the wealth, kind of needs some of these financial metrics to be a little stronger to maintain and get to that AAA level. That's not to say that that was their motivation, because these guys have been AAA for so many years, decades and generations, that it's hard to say like what started that. But it also could be that just year after year they're budgeting and conservative, and it just goes up a little bit more. And you know, the goalposts have changed too over the years. I think, as we might have talked about at one point, for those of you who go back long enough, like, you know, me, I guess, back in the early 2000s, late 90s, it was all just, 10% fund balance, 5% undesignated. Well, undesignated isn't even a term anymore. And the 5 and 10 it's meaningless. Those were just numbers that people used because that's what they thought that the rating agencies wanted. They weren't transparent. It was a black box. Nobody really knew. So those were just like the things that got kind of thrown around. Now, because of, you know, the medians and all these new criteria and things of that nature, we've gotten to a point where, you know, the total fund balance median is 17% for a AAA and unassigned is 14. Well, that's not necessarily the rating agencies telling them that you have to have this to get a AAA, but you know, once you're in that category, from year to year, if they all just keep bumping up a little bit each year, that median is going to continue to go up. And now you're all going to be sort of compared to these other numbers that just keep sliding up and sliding up, whether we agree with it or not. I don't think it's really necessary to have a 25% fund balance when you get 80% of your taxes or 90% of your taxes from property tax, which is like the most stable source. So, but that's kind of the nature of the world we live in, is because that, you know, as these things move, the medians change, and then they just say, well, you know, compared to your peers, you know, you're lower now. You say, well, anyways.
Mr. Curley?
Yeah, thank you, Madam Chair. And I think everyone on this board is aware of this, but certainly for the public's benefit, I think the other thing that strikes me is that Fairfield has grown its fund balance pretty materially in a relatively short period of time, if you go back the last 10 years. Also, Fairfield's enjoyed, rightly or wrongly, close to $30 million of surpluses in the last 3 years that we've designated for other purposes, whereas other towns could have taken their surplus and put it to the fund balance as well. Had we done that, we would have been up in that 20% range. And now we've grown this percentage, the coverage here for the fund balance, but it certainly could have been much higher had we not taken action to designate those surpluses for other purposes. So I think, generally speaking, this is a good story.
Yeah,
That's a good point, and I agree with that. And that's the kind of dialogue that we have when we talk to the rating agencies with Fairfield, and we can show them that, you know, these things were funded, or this is where we've put money, and that's a very good point. So I agree with that.
Yeah, I mean, basically, we took those surpluses and we funded projects rather than incurring debt to do that. So just to follow up on the West Hartford question, West Hartford, the thing that struck me that you said was it was two things. I remember the pensions were significantly underfunded compared to ours. And OPEB, I was actually quite surprised when we got the report that our one OPEB plan was up at 60%, which is pretty amazing. From zero not that long ago. But what was the other West Hartford thing? You mentioned two big things.
Well, their fund balance was and like the cash liquidity ratio was also kind of on the low side.
Okay, but the pension, and they did a big pension bond, you said. Okay. All right. So yeah, I think those are areas. Yeah, it'd be interesting. Let's look at the rest of these charts.
All right, let's go to chart number 2.
3.
Yeah, oh, good. We can skip unassigned. All right, keep going. Anyway, we talked about unassigned. So again, just to kind of give an idea as far as the criteria, we talked about the finances, then we're going to talk about debt. There's some economic metrics that we work into here, and then there's the management component. So we're going to kind of try to hit on all those things as we move through. So this is debt burden. So just overall net debt to equalized grand list. And you can see, so this is the one outlier chart that being on the right is actually not the ideal situation. So just if you were to flip that in your brain, so you're like fourth over from the side, so a little bit on the higher side. But again, not all the way on the highest. So kind of, I think overall the debt is sort of more middle of the road if we continue to maybe go to the next one. Yeah. So now this is overall net debt per capita, and you can see kind of in a similar slot as the last. Okay. So I don't know what happened to the chart. It's hard to see, but I could just look at this here. So that's overall net debt per capita. And you can see that there on the fourth from the left. Another metric is on the next page, debt service to operating expenditures, which basically is budget. And again, these are all GAAP. So it's also important to note that in case something doesn't line up with what you have in your brain, because that was a budget number. So we have right in the middle, just over 6% there. Okay. Yeah. So then now we have a kind of a wealth metric, equalized grand list per capita on the next page. And you have, right in the middle there. I mean, you're dealing with lower Fairfield County, which obviously when it comes to the wealth is going to be higher, typically speaking. But you're right there. The bottom line is this obviously doesn't scream that there's any kind of concern or anything like that. The next page is the same thing, per capita income, again, right in the middle. Not surprising. There's some decent housing value numbers on the next page, again, right there in the middle. Maybe tilting over to the higher side there. Median price of a house for AAA is $627,000. Look at that. That came up a little bit in the last few years. So that's one of the metrics that the numbers really went up in the last few. Tax collection rate, again, is just, obviously important, and everyone here on this page is over 98.6%. So this is, none of the gradations here really are meaningful, but it just kind of shows you where you fall, which is pretty impressive. Most current unemployment rate from December, this past December, just over 3.5%, which historically speaking is among the lowest it's ever been. And we'll see how that progresses as things change in the economy. And just a couple of final slides, which just incorporates all your bonded debt and then your pension and OPEB liability, and all just mixed and mumbled into one big ratio per capita. And, on the slightly higher side, but in rather good shape. And the same goes for the grand list on the next chart. And we show these and the scale matters. The fact that it's even the highest ones here are 3%. Like 3% for this ratio is not a high number. You know what I'm saying? So it's important to know that, oh my gosh, we're almost, sometimes you have to look at the absolute number and not necessarily just the ratios. And that's part of the process of going through the rating agencies too, to explain that stuff to them. But that is the end of my formal presentation. If there's any other questions, be more than happy.
Okay, questions from the board? I know we had some as we went along. Does anyone else have any other questions?
Madam Chair, this is Jack. The only question I would have, and it's not really a question, it's more of a suggestion, is perhaps we could have a 6-month check-in, and or if there's any red flag, for lack of a better phrase, we could have a check-in. I understand it's typically it's yearly, but I just don't think it would hurt to have maybe a shorter summary, but I certainly appreciated this was very comprehensive as always. It's great to have it again in front of us. I just would like to keep track of it, A, B, make sure we're where we are where we were last year, which is in essence the same from my question earlier this evening.
Yeah, okay, and maybe we can talk offline. I'm not sure we would to do a mid-year check-in because these benchmarking numbers are only reported annually, so we're not going to have 6-month numbers from any of our comparative towns here. But let's think about that, and we could talk offline. Mr. Matola?
That's true. And maybe this goes to what Mr. Testani is getting to. Does a municipality get a warning? We get warnings if you may be going from AAA to AA. Is that correct? And can it happen from year to year, or do they give you a warning so you can make whatever necessary adjustments you need to make so you can stay at AAA? How does that work?
No, that's a good question. And I would say this, for a town like Fairfield, a AAA bellwether, Connecticut, Fairfield County, it's the same, it's a name that's out there in the market every year, which is important for this purpose. It would really surprise me if there was a rating change out of nowhere. First of all, they happen 99% of the time when you're doing a bond issue. Okay, so it's not like mid-year they're gonna, make a change or something. We've been through a lot of fun things in Fairfield over the years that have happened off cycle of the issuance, and we've all dealt with them and addressed them and maintained ratings. And I have a little list of fun things that we could bring up that I won't. But it's all the good stuff that happened, or the not so great stuff necessarily over the last 20 years. But to your point, typically I would think that if something were to deteriorate, it would be most likely in a scenario where we maintain a AAA bond rating with a bond sale and we get put on negative outlook. That would be the scenario. And then the negative outlook basically means you have the expectation is between 12 and 18 months that something's got to give. Either it's going to go down or it's going to go back up. That happened to Fairfield once, quite a while back. And we got the outlook taken off very quickly. You all did. No, I didn't, I was there, but so it was very fortunate that happened, and it happened to Wilton, 18 years ago, same kind of thing. And it was removed. The only caveat to that is the scenario that I mentioned with the Ridgefield, West Hartford, which was when they changed the goalposts on you. There's a methodology change, and it tweaks it enough that it puts a couple towns maybe in that danger zone. But even then, they reach out to us, and it's a process, it's a dialogue that goes back and forth that, gives you an opportunity to say, okay, what are the deficiencies exactly? Here's what we're going to do to address them to avoid potentially that rating change. And that's exactly what happened with the Ridgefield. So, yeah, I wouldn't expect there would be ever a time where we would be blindsided with anything like that.
Thank you, Mr. Matola. Mr. Curley?
Thank you. And I agree. I love this presentation. I'd love to have it more often, but if the data is not going to change, it doesn't make sense. But what the question I have is that the next part of our agenda tonight is we're going to be talking about some of our capital projects. And as we look at some of the projects that have already been approved and not yet funded, so those are kind of in the backlog for us, together with some of the projects that are about to occur or potentially, our bonding levels may have to go up, and that'll be a discussion for this board and discussion for the Board of Selectmen as well. I imagine that to the extent that our bonding activity starts to potentially increase as the town's financial advisor, in advance of any warnings that we might get from a rating agency, you're going to advise the town that, hey, wait a minute, we're getting a little too close to the third rail here. Is that part of the dialogue that you might be able to provide us on an interim basis?
Well, 100%, and that's something I do. I talk to the town very regularly on, going back for numerous years with respect to this waterfall model that was created 15, 18 years ago, whatever it was. But yeah, and that's pretty much the whole. Well, one of the points of that model is to see how it would impact ratios, how it would impact your debt service, what the charts look like, what the impact is. And then you can kind of see, well, okay, it's going to do this to the debt figures. And, obviously that does nothing to strengthen your rating. So it becomes that much more important to maintain all the other things that have gotten you to this point, and even, maybe strengthen them a little bit if you can. So yeah, that's 100% something that we talk about and is an overarching theme of sort of what we're thinking about when we're putting that model together.
Just one small question on these pension numbers, and the place I see them in here is this chart we were just on with pension and OPEB liabilities to per capita and to the equalized grand list. When you agencies, whoever, when you're looking at funded status of pension and OPEB plans, do you look at the numbers that we saw presented from Mr. Santafonte, which are basically based on funded status as of a point in time, not that actuarial number with the smoothed? Okay.
Yeah, it's funded status,
Yeah.
and
So you look at the gap number, in other words. Okay, and I thought so because we've heard, I heard it insisted in the past that we use the actuarial number. I don't think that made sense. We use the gap number.
now that said, they get the reports, like they might ask for your most
Right.
recent actuary, and that'll get worked into the analysis. But it's also, pension liability to whatever metric you want to use, and with OPEB and bonded debt. But it's also very, and potentially even more important in a way, is annual funded ratio, like your contribution.
Right.
Like making sure that contribution,
You're fully funding your income every year. Yep.
that
Okay.
is critical.
Yeah.
Very critical. That's one of the things that from one year to the next, that could make an impact on your rating.
Yeah.
And create a real uncomfortable conversation
Yeah.
with the rating agencies.
And I think, going forward, whether we have an interim update or not, again, I'm not sure if there'd be benchmarking information available, but one of the things that might be interesting is just even if it's a bullet point list of some of those other factors. I recall that when we got our negative outlook, it was because of our negative fund balance in our internal service fund. So that's sort of not something that's presented in here. Fully funding your ADEC every year is, you said that's critically important, but that's not really reflected in here. So some of those, it would just be interesting to understand some of those other, I'm not going to call them subjective, but just the other more nuanced factors that go into the determination. That'd be helpful. All right. Any other questions from the board? Right. Thank you, Matt. Appreciate you being here in person. Thank you. Are you gonna stick around?
If you'd like me to, which I thought you probably would.
Yes, if you wouldn't mind, because we have this discussion coming up around capital plan, which I know you helped with, and obviously that capital plan has a big impact on those numbers, and ultimately will impact the numbers and the future numbers in this presentation. So that'd be great. We appreciate that. All right. Okay, so we will move to item 5. To hear an update and discuss the capital plan and waterfall. So for members of the public, the backup for this item begins on page 221 of the posted materials online. Board members should each have a printed version of the documents. So before I turn this over to management, I just want to say a couple of words to introduce this item for the benefit of the public. Typically, this board reviews the town's capital plan in the fall at an annual capital planning workshop. And the purpose of that workshop is for the administration to lay out its long-term plan for capital expenditures that are intended to be financed through bonding. We don't vote on capital projects during that workshop, but we review the plans so when the projects ultimately do come before us for a vote, we can evaluate them individually, knowing what their impact on the full financial plan will be. We did have a workshop last October, but at that time there were a number of issues, open issues with the plan that came before us. There were some errors, there were a bunch of open items, some significant uncertainties, particularly with the WPCA. and also a number of questions related to how the plan would impact our future bonding and debt service requirements for both the town and the WPCA. And all of our board members agreed that we wanted to review an updated plan before we started voting on projects. That brings us to tonight, and that's why we are here in February reviewing this again. So the administration has updated the materials, the updated capital plan and debt waterfall, as I said, are included in the posted meeting materials beginning on page 221. I want to thank them for providing this data to us. The materials are comprehensive. They've been responsive to all the requests for information that came from this board. I especially want to acknowledge Sabrina Bernardi, who works in the finance department, who put weeks of effort into this, working with all the department heads, incorporating all of this board's questions, and ensuring that all the data in these schedules was reconciled to Munis and our audited financial statements. It was a huge effort. So if anyone sees her, please thank her. And I also want to thank Caitlin Bossy, who helped lead that effort as well, along with the first selectman and Mr. Becker. So with that, I will turn it over to the administration to walk us through this.
I would like to also thank Sabrina and Caitlin. Cannot overstate the effort they put in. Sabrina dug in 3 times, 4 times on some of these projects. And I believe we're at a place now where I feel comfortable is a good starting place. I also want to thank you, Madam Chairwoman, because you were very clear what the Board of Finance needed to see to get comfortable with the numbers and what this process ultimately proved out. And I think some of the things you've been asking for some time, I think the biggest thing that it proved out is approved, authorized, but unissued debt has to be in this presentation for it to be a valuable document. So if you go to the first page, the top section of the summary page has authorized but unissued debt. And that I don't believe has ever in the presentation before. So this is debt that we would expect, has been authorized, we would expect to be issued in the coming years. That has to be added to the debt that you would expect to issue on new projects. And that's why a lot of these numbers are, that's the main reason a lot of these numbers are a lot bigger, excluding WPCA. WPCA is the other major change in this. If I would say there are 2 huge changes. One would be authorized unissued debt, and the other would be on the bottom section is the WPCA debt. This is a result of 3 studies, 2 comprehensive studies, and one sort of best effort by Ty and Bond to do pump stations and how that would be rolled out over the coming years. The first major study was Wright Pierce did a study on inflow and infiltration, which is something I've been talking a lot about. I think everyone probably knows what that means, but our pipes are very permeable. Up to 50% of the inflow into our pipes is actually from rain or from the sound during a storm. It pumps through to the pump station, so we may be nearing capacity at times, but a lot of that is not natural flow. That is because of permeability of the lines, and that has to get fixed. So you're going to see under the WPCA section $1.5 million per year for that. The second part is a Woodard and Curran study where they looked at the plant itself. You've seen numbers that in the past that were 125 million, if I remember correctly, for plant alone. This number is significantly smaller. The first year, what are the current data? I would recommend that so online. They've been posted on the WPCA website in the file section, WPCF website. They ranked the most important ones that, high, was it high, medium, and low? The high, we're going to do this year. So we're going to try to get out and get that done. And that's over $10 million. And then you can see the numbers when we get to that section. The third piece is we have pump stations that have to be replaced. And two of them, one is Beach Road. And the second, I believe, is Center Street, if I remember correctly. And those, we're talking $9 million one year and about $7.5 million the next year. So this is really high priority. But over the course of the next 10 years, the total amount is about $100 million. And right now, one that we have to nail down in this report, which is going to be a little flexible until we get some better numbers for the plan for WPCA, is we're not exactly sure what year it's going to happen, but at some point, and in here we're showing that 2030 is the first year where WPCA cannot absorb the debt they need in order to fund these projects, and it will flip over to become debt of the town, and that is shown in two sections. There's a section under town-funded WPCA debt, and then there's a section for WPCA-funded WPCA debt, and we can get to that in a section. So should we sort of, any questions on the cover page, or should we just start going through?
Does anyone have questions on Mr. Curley?
Yeah, and looking forward to getting into the detail, but before we get there, I just want to make sure I'm clear on the format that's been laid out here. If I heard you correctly, Mr. Selectman, Mr. First Selectman, the top two lines are the already approved, authorized numbers that just have not been funded yet.
Right, and there's a whole section in the next section where you can see each project that you've already approved.
Yeah. Okay. So, and then subsequent to that, you've got additional numbers broken out between the town, Board of Ed, WPCA, and just looking at this upcoming fiscal year 2025, it's a $63.4 million number, right?
That's right.
Okay. So again, we can get into the detail, but I just want to get to just set the stage. Is the detail here what you're expecting the town will actually come forward and ask for approval on? Are we setting ourselves up for a $63 million bond this year, or are you have you laid out basically, I don't want to call it a wish list, but a number that now needs to be managed down to a lower level of debt?
So Sabrina, with engineering, sat with engineering, going through these projects one by one multiple times, but I still would not feel, I think that's why I'm saying, this is a format that we like, but I wouldn't say we're 100% or anywhere really near 100% comfortable that all of these projects are really going to happen this coming year.
That's fine. I just wanted to understand before we got into the detail. Thank you.
Yeah, I'm sorry. I should have said that I view this as day one of, well, it's not day one for Sabrina and Caitlin, but it's or David or myself, but it's sort of, this is what we want to be able to present to you going forward. And some of the numbers for the upcoming year are probably gonna get pushed out.
Yeah, but it's important for the public to understand, I think you've mentioned this, I think on every single one of these documents, it says for discussion purposes only, right? We haven't made decisions yet.
You want to answer?
Yeah, and let me just something out too. I'm glad that Mr. Gerber clarified that, because, so this is what the departments, if I can paraphrase, have put forth to say, yeah, we believe that we do these projects, and yes, we're going to do them in a time frame that would be required to be bonded as it's laid out on the schedule. So if you even talk to the department heads, they would say, yeah, we're going to need to issue 63 million in bonds next year, okay? However, back to the authorized unissued. The reason we have almost $18 million of stuff that we've approved that has not been bonded is because of that very fact. For this year, is because, you know, time after time, we get projects, we're asked to approve them, and then they may take a year, 2 years, or longer to come to fruition for various reasons. You know, the design takes longer, the bidding process takes longer, we get bids, we don't like them, we go out to bid again, whatever it is. So that authorized and issued, and we never would know that. You know, we used to, the way that this schedule was presented to us in the past, we'd see the project in the column in the year that it was going to be requested for approval. So what this is it's moved to a cash flow basis because the whole point of it is to show the cash flow and show when this translates into borrowings, then it moves into our debt waterfall. So that is a huge, you know, it's something we've been asking for consistently over the past couple of years, and we started making baby steps to get there, particularly on the Board of Ed side, but that's what this represents. It's a cash flow representation. So when you get to the detail, you'll see the project costs are laid out there in total, but then you might see the bonding spread out over multiple years. So that's very important. It's a way to manage it. Now, back to Mr. Gerber's point, you know, again, there may be some optimism in here where the department heads have said, yeah, we absolutely think we could do this year. As they dive in more, they vet, you know, they may find for one reason or another, it's just not feasible operationally, financially, whatever. But I did just want to point that out and reiterate that moving this to a true flow basis versus what we had in the past, and keeping the tracking on here for everything that's been authorized. Regardless of if it's an active project, we're going to have accounting for it in front of us now. Was critically important, something that we've been wanting for a long time. So, you know, I'm sure we'll have plenty of debate about the projects themselves, but at least now we have the data in front of us to be able to evaluate it. So
David wants to say a few words, but I just want to make the point, sort of jump to the end a little bit. Even at these enormous levels, when you get to the end, you'll see we come close to 10%. But we don't break that. We get up to the high 9s. So this is a conversation that we had with Matt last week. I said, you know, what is it that would cause us to be downgraded? And he sort of talked a bit about the things that he talked about tonight. And he said, like, this would be one factor, but there's a lot of factors. And he said, you know, really, the real issue for you is the mill rate. You know that it's not for your rating; it's the mill rate. If you're going to raise this much debt, it's clearly going to impact the mill rate.
So, and I'd also add, if you look on the Phoenix advisor sheet and you look at the amount, if you look at the amount that it would actually increase on an annualized basis, even as we step into it, even with these fully loaded numbers, for the most part, you're looking at annual change. There's a peak year that hits 4 million, and you've actually, even in a couple of years, you've got a year that wouldn't even be $1 million. So when you talk about how much that affects the mill rate, it's actually not a drastic figure if you fully did this and stepped it up. But to the point about it, the authorized unissued component, we've made, you know, some changes, and we're going to further refine now. We've looked at some of the projects, and we're beginning to evaluate, and we want to, over the coming months, come forward. But there are also projects, I take Tide Gates as an example, that they keep kind of piecemealing. And we're looking at, well, maybe we go for the approval for the full Tide Gate amount. We have that, and then we inform the board as we're spending that down, but that would be spread out. Now, that would avoid things like, one of the things that we've found, I think everybody knows, departments are constantly on some of these things coming for all these little smaller projects over and over that have the same theme. So one methodology is, get a 5-year project approved, load it in from a cash flow basis. That's there. We update the board on what we're doing as we go through it. So I just want to kind of point that out as one of the things. There's the changes document, I think, is a lot of starting to kind of clean it up, and we're starting to go through on that. And I think same, if you look at it, that's, we hit the theme on the amount of money that can actually even programmatically spend. I mean, there's only so much capacity inside of the town engineering departments, or so much even when you go to building committees. Some of this forecast shorter timelines that we just know always get spread out, but we're trying to load it all in, let everybody get a handle on it, and then, sort of step from there.
Yeah.
Yeah, Mr. Conley.
Thank you. Now I have a question. I think I'm clear from what you guys said, but there's dates on outside of the area. I'm on, just for reference, page 6.
Like the approved date?
Well, but there's approved dates in stuff that's not in the section for previously authorized and approved. Or maybe it's just a.
What page are you on?
Page 5. Page 5. So 255 of the backup material.
So
So there's a capital,
the authorized date?
just says June 30th.
So, yeah, the June 30th, so are you looking at the DPW capital equipment, 2,377,000?
Yeah.
Okay. Now, I'm not sure, is that authorized date? Is that accurate? I'm not sure
It
that's
is,
right.
that has been authorized already. I don't know.
Okay,
if
yeah, I don't think
it's 22 or 23, but it has been.
okay, yeah, the date looks funny. I don't remember ever having a meeting on June 30th, but, okay.
Oh, June 3rd, okay, yeah. Yeah, that might be.
Okay, yeah, I know that we, so to your, yeah, we typically, or at least the last couple times, I think we've authorized DPW equipment purchases for 3 years. And so that would be an example of something that would fall into the authorized unissued bucket, because the bonding for that equipment would happen over a 3-year period, even if we approved it in year 1. So if that number is not picked up in the roll up on top, then maybe Caitlin just check on that.
Oh, okay.
The idea is that anything that's an authorized date is something we already approved, as opposed to the others. So it should be in that top number.
Hi.
Hi.
Just want to make sure I'm reading this correctly. So this has us going from 25.6 million for fiscal year 24 to 63.4 million, correct? And I understand it's a wish list, but that's the numbers I'm looking at, correct? Okay. And when we had a meeting prior, you had expressed a lot of concern about the waterfall. And I know you mentioned that there's been a lot of work done, but you really had very little faith in the accuracy of the numbers. You had referenced finding a number of mistakes that needed to be adjusted. Do you now feel comfortable that that work has been done, that we're looking at accurate numbers? Or are you still concerned with the estimates?
No, I'm not concerned with, I mean, it was it last month? I mean, time is, yeah.
So, December.
So last month, leading up to that meeting, I was trying to prepare for it, and the numbers changed 3 or 4 times, like in the day leading up to the meeting. So I didn't feel comfortable presenting those numbers. But I feel comfortable with these numbers conceptually. They've been vetted multiple times. However, I do believe they're probably going to change.
Yeah, I mean, this is clearly a pretty big wish list, and I'm sure that it's probably not even possible to get all these projects done if you wanted to. But I just wanted to make sure that you felt comfortable with the numbers, just to make sure that we could take that out of the equation. And I know you guys have been working hard at this, so I appreciate that.
I just want to follow up with one other thing. I quickly said yes to this 63, the 25 to the 63 is apples to apples for the most part, but there will be a band component to that. So the 63 might not all be bonded, but it might be band, which is the shaded column next to it. So normally I work with Matt and we kind of smooth out what should be band and bond. Yeah. Yeah.
So in other words, for comparison, the 25.6 and the 6.6. So the total of that would compare to the 63. Yeah.
Right. And as we go through some reconciliations between some of the spreadsheets where bands are included and not, so we can go through that and point out those differences.
Mr. Curley.
Thank you, Madam Chair. And I agree with Ms. Ruggerio's point. I think in the past, we've had concerns not just about the dollar amounts, but also the format and the information that was being conveyed. If I heard you correctly, this is a market improvement in terms of the presentation and getting our arms around the format, but the estimates that go into each of these line items, these projects the numbers may change, but the format and seeing how the numbers come together is improved.
So I think we need to have happy staff. And we have some really, really good people working for us, but if we don't get this process working in a little more automated sort of, I mean, Sabrina can't go through this every month. She won't last. So, so what we need to do, I mean, we're looking at, different types of software solutions to sort of, I mean, ideally, I'm not a software person, but ideally it would be some sort of distributed thing where the project managers can enter things in, but that they would have to be approved maybe centrally to make sure that we understand them with commentary every time a change is made. And we haven't really found the perfect thing yet. I know Eli Gazal's been out there trying to search the universe for something, talk to CCM to see if they could do some work for us. But, ultimately, we may have to piece something together. We haven't even really looked at Munis yet and what they can offer. But it could be like, I mean, David is, kind of a software kind of guy. And we may end up piecing things together, but we need a system that is updated in a dependable way that gets people off spreadsheets and Excel spreadsheets and incorporates WPCA, which is now, as you may well know, is sort of really coming back to the mothership in terms of management and also so it's going to have to be one system where we can check that. So.
But I think that the important thing for me is this is the first time in 2 years that I feel like I'm seeing all the puzzle pieces put together. Now, and again, I think this board has had frustration in the past that a project would come to us and it was originally estimated to be $2 million and it comes back and it's $6 million. So what happened, right? So there are two different issues from my perspective. One is, the quality of the estimates that go into this, but then secondly, how the information is aggregated and pulled together so we can see the whole picture. I feel like you've got a tool here that provides that latter piece, but we always have to worry about whether the estimates that go into it are credible or not.
I think one thing we will work on, we have to work on as we implement this is like a coding system where, 1 means like I pulled it out of thin air all the way through 10 means, we have a guaranteed maximum price and everything in between. And so that, you can see those move along the continuum. That's important. The other thing that's important is we need to make sure everything's escalated properly. And so those assumptions should be readily, you should be able to see them, what the escalation assumptions are. We're not there yet, but this is sort of, working with Lori, this is sort of, when you I'm not probably the least capable person to describe it, but when you want to know what kind of software you're looking for, you can sort of spec it out and say, this is the template that we need to get to in the end. And there's got to be a process that's put in place that allows us to do that without, killing people every month or,
Thank you, Mr. Curry. Yeah, and I would just say one thing. I mean, the 10-year plan is critically important. I'm very glad that we're looking at 10 years. We had truncated it to 5 for some reason over the last 2 years. I didn't agree with that because, these are long-term debt issuances, and just so happens that some of the biggest items we have to confront are in the second 5 years here. That being said, I think the other thing that I would say is that, one of the more frustrating elements is that, everyone understands there's estimates in the out years, but getting the upcoming year right is really important. I mean, I think if we're at the point where we are estimating numbers for the upcoming year, so this fiscal 25 bond, for example, we're talking about debt that's going to be issued in 4 months, 5 months. That's not that far away. And so I hope we get to a point where at least we know the upcoming year is rock solid. Like, that shouldn't be a wish list. Those estimates should be as good as they can be. And then, with an understanding that as you move out, there's going to be a higher level of estimation, a higher level of judgment, and a higher level of uncertainty. But, part of what we've been confronting is we would, sometimes get a new plan every, with every meeting, and things were changing constantly, even in the short term. And I think whenever that happens, it's just important to go back and reflect on why it's happening and figure out what we can learn from the process, so that at least we can, understand what our short-term requirements are. Because these are, these fiscal 25 numbers, we may be getting asked to approve some of these in our next meeting, right? So we want to know that fiscal 25 is solid before we start approving things, later in the month. So that's one element of it. I think that has to be as good as we can get it. So all right, I'll stop talking.
Well, I don't know if you want to go through each one by one. We'll be here by tomorrow morning, but I do want to point out, if we go to page 420, just if anyone who, and I see he's probably trying. She's you've got your CPA, right? Yeah. But if you go to 420 in the first section at the top, and you'll see under remaining authorization, there's a number 499, 941. And if you look at the summary page, that number is 10,926,006. And the reasons for the differences are as follow. The 10 million does not include the ban of 2670. So you would add that in, because this is total FY 25 to 34. But on page 4, you'll see a little under fiscal year, column fiscal year 26. There's a number that we could try to make this more obvious in the next version, but authorized, which will not be bonded. And you would have to then, so you add in the band and you back out the amounts that will not be bonded. And
so are the amounts that will not be bonded, are those authorizations you plan on canceling?
Caitlin, we're going to cancel this? The 5, 7.
Okay.
Yeah, we're not going to be bonding this.
Got it.
And there's a similar section under Board of Ed as well. But I'm not sure how do you want to go through each page or?
Yeah, I don't, so the purpose of this meeting we do it in the fall is not to do a deep dive on the projects, it's to look at the numbers overall.
Well, I would love to.
But it would be great for you to take us through the highlights that you want us to understand. Yeah.
Well, I mean, I'd love to talk about the next section, which this is your baby, Larry. The budget actual spending.
Okay.
Yeah, so this is really a breakdown of the remaining authorizations. It's 10 of 20.
10 of 20. And so for the public, if you're looking at the PDF, the 10 of 20 is actually printed on the bottom of the document as well. But the title of this, it says Town of Fairfield Capital Plan Budget Actual Spending. And this is active open authorizations. So we used to get some version of this during our quarterly meetings, but it was not complete for all open projects. So I'll let Mr. Gerber take this. So part of the idea here is that, yeah, once a project's approved, you know, again, some of these projects get approved and bonded over multiple years, but things are happening, money's being spent. So this allows us to see kind of project status and what's happening, so.
Yeah, exactly. So, I mean, this was very useful to me. This ultimately, this ties into the summary spreadsheet as well. And yeah, so exactly what you just said, it allows you to see what's been spent to date against the projects, and the last column, the remaining authorization. If you go to the, page 13, it gives you a total. That total, if you have to then subtract the not to be bonded, that ties into your cover page of 10/9/26/06. For that category, we can do that for each category. But if you want to see the status of the projects, like you said, you've seen it in the past, but this is a complete list that ties in.
Mr. Mottola.
So if, I'll give an example on this, on page 10 of 20. The Independence Hall office renovations, we approved $500,000. We bonded $300,000 to date, right?
Mm-hmm.
So does that mean that, and I don't remember the specifics of what we were going to do there when we approved it, but does that mean we did what we wanted to do for $300,000 or do we still have more work to do for $200,000? Or what does that mean exactly?
Well, there's more work to do.
Okay.
We have to decide. I mean,
There's comment to the staff.
done.
Look at that. Thank you.
Yeah. So, speaking of commentary for everybody, most slides, and it's to be determined.
Okay.
So John, you could kind of see in the total spending to date, they've spent the 418.
Yeah, I see
Of
that.
the
I should have
500, right?
great reading. I apologize.
So if they do spend the entire amount, then I'm gonna bond the additional 200 because I've already bonded 300.
So how do you just go to and I'll stop asking questions after this. Burn Mansion kitchen upgrade, 20 years. $228,000. Net to be bonded, $228,000. We've only bonded $215 and change. So did we complete the project and we don't have?
Yes, so the total spending to date is the
Okay.
215. So
That's all we bonded for, 215.
yeah, so there's a remaining authorization that I'm never gonna bond that.
And when we approve a project and what we're gonna bond, it's always understood that that's the limit. We could finish a project.
That's the
below.
limit, and a lot of times, obviously, not every project hits that
Right.
exactly, which is why there's always underages. They can't spend more, but I could bond more than they spend, not knowing that they're gonna underspend the
Right,
authorization.
I get that.
So, yeah.
Okay, thanks.
I would add, and I think this is something that I think about our conversations back when I was on the board, and now I kind of look at from this perspective, and Caitlin walked us through how they manage the funds. So, you look at the Independence Hall component, they bonded the 300. That didn't mean without bonding the 200 that they couldn't expend the additional funds. They have the authorization, we have the float within the overall accounts for the town. So she tries to forecast it, similar to sometimes they come back and they say they're going to spend an allocation. So she goes and does, puts together that that's gonna be on the bonding schedule, and then they don't spend as much during that year. So there's an ebb and a flow there. And the goal is really when the bond, when the bonding takes place, to try to keep that as tight as possible, right? Not to overdo something. And if you underdo it, you still have the flow towards the end of the year, then clean it up in the bonding. So Independence Hall would just be a prime example that doesn't exactly match in all the lines, but when you sort of understand that story, it sort of comes out.
Thank you. Mr. Penley?
So for example, that you were talking about Burr Mansion, where you have something where there's a remaining authorization that you don't know you're going to use, does that still spill up to that cover sheet in the authorized and unbonded?
Yeah, but that's that piece that Bill mentioned that we're not going to bond.
Right, okay.
Because I'm not gonna bond because they're not gonna spend it. I mean, if you look at the project ID, that the first 3 digits represents the fiscal year. So this was back in 18 that it was approved. So that was like 6 years ago. So they're really not gonna spend that. So they've spent the 215 out of the 228. I am not going to authorize the 12. So that's basically done. So that would be part of my cleanup, kind of where there's little underages and overages by year. And so we say, oh, if there's extra money in a certain capital non-recurring year, we could allocate it to a year that needs money. So we do that periodically.
Yeah, and this is and to pick on maybe Independence Hall and Burr Mansion as 2 examples. I know these are small dollars, but part of what strikes you is that, and this is just how things happen. We approve these projects for round dollar amounts based on broad estimates. Sometimes, they drag on for a long time. We've never really gotten good status reporting on the projects like this. So ultimately, you don't know if you're getting for the $500,000 what you thought you were getting when you authorized it. We don't really see the status. We don't know what's happening with the money, or if there's leftover. So I tend to think, it's one thing if you're building a school, but when you have these types of projects, to me, I don't like to see authorizations sitting out there open for 3, 4, 5 years. That just shouldn't happen. Like it's not only administratively an extra, cost to track and deal with, but it's a risk. These are open authorizations, and we shouldn't have that. Projects should be defined. They should be finite. We should know what the money's going toward. They should get done and they should get closed out. So I think, having this tracking, it'll enable everyone to, look at this stuff on more of a timely basis and, get a better understanding of what's happened with all these projects approved. And I will say I've heard this again and again, including from several RTM members, that, we approved this stuff. What happened? Did that project start? Did it finish? We don't know. And so this is there's a lot here. I know there's a lot that went into putting it together for the first time, but now that we have it, these numbers come out of Venus. We don't have to create it all the time. And so good mechanism for us to, for management and for us to be able to see what's happening with all these open projects. So
I believe a great example of something you would have wanted to know is the digester that was approved and it wasn't acted upon. And then the digester blew up. Yeah, like many, many years ago. And those are the types of things I think you would be able to, see this.
okay, so budget to actual. Does anybody have any questions on that? All right. Did you want to touch on the changes document or more?
I'd like to touch on it mainly because Sabrina put like 100 hours of work into this. But the truth is, so this would be page 15. The truth is, this is from the October capital plan that you looked at. And as you mentioned, I don't think you approved it and you found issues with it, but we needed to start somewhere. So, this is the format. Really, I just wanted to show you what the format is. So going forward, we will be able to show like the next iteration will be rolled forward. It'll be easier for her to do. It's because it's set up, to roll forward. As long as it's forward, then we should be able to go through each project and explain why the numbers changed.
Yeah, I know Jim Walsh had asked for this, and this is helpful. And I think, from my perspective, we, historically, we would get these different plans, and the only way you could figure out what changed was to try to, dig out your old spreadsheet and compare the two. So what this does, to me, is very helpful because it rolls forward the last plan to the current plan. So you can see which projects have been added, which may have been deleted, which ones the numbers changed, which ones were maybe just missing before, authorized unissued, for example. So they were out there, but they hadn't been presented on the schedule. So, this takes the first couple pages of this have all the changes that were made. So you can see all the work, you could see the level of vetting that went into this with all these changes. And then if you go to page, I believe it's page 20, it adds up all the changes, and then it takes the old plan we looked at in October and ties out to the new plan. So, my hope, and I appreciate that the first selectman and Mr. Becker, caveated that obviously this is a starting point, but, hopefully we don't have this magnitude of changes going forward as this gets better. Hopefully the plan stays a little more stable. Because there were a lot of changes here, and, the numbers in the aggregate changed a lot. And you can see a bunch of these are just adding authorized unissued. There's some movement from the ARPA schedule to this. There's some new things. There's some changes in numbers. Some numbers increase for inflation. Escalators were added in. So, quite a bit here. But again, going forward, the hope is that, the plan starts to stabilize so we don't have this level of update every time.
And a big part of, there's some big projects
Yeah.
that weren't really nailed down at all in the past, like WPCA was a big.
Okay, Ms. Ruggiero.
So I understand we're not going to go through this in detail tonight, which is great. But when do I had the pleasure of attending in October before I became a member. And I know there was a lot of conversations specifically, like I'll use Dwight School because it's very near and dear to my heart. And I know we talked about possibly even moving some of that up when we were talking about that. But I look in here and I see it's been actually probably pushed back. I didn't bring my sheet from October, but I'm going to look at it when I get home. When do we go through this? And then when you brought up ARPA before, I know obviously we have a crunch to use that money and we have to have projects ready. And that's a big concern because we don't want to lose any of that gift, so to speak. So do we get an update on that as well?
Yeah, so typically, we don't have a meeting devoted to this as we normally do. I mean, if there's any questions you want to ask tonight on details, that's fine. Or if you want to, anybody on the board wants to aggregate questions to the next meeting. I think we may have some voting items at our next meeting for some of the smaller projects. So, we're going to get to the point, I think our next meeting, possibly March, but before we get to budget, we're going to start voting on items. So if there are questions that anyone has, particularly for projects in the upcoming year, please feel free to send them in advance and we can get those questions, we can get plan questions answered at any meeting where we're voting on items so that we have the benefit of doing that. And then ARPA, that's the next item on the agenda. So obviously there's interplay. We can talk about things that moved between the two schedules as part of that discussion, if that's okay.
Yes, and Rooster River is also on our agenda tonight, but I assume that's on here as well, right?
Yeah, the grant's on the agenda, but the Rooster River project itself, yeah, I mean, do you have a specific question that you want to ask about that?
No, I was just wondering at the correlation to this and how does it tie in?
Do you want to address that?
Well, we have phase two, but then also there is, well, it's on the schedule, and if the board would like to bring it up as a discussion point, there's the Rooster River on the ARPA schedule. So that's the phase one part. And we can tie that out probably during that discussion further back to the bond.
Yeah.
We sort of more or less asterisk that as there's dollars that are there, and it's either going to go to Rooster River as a bond or somewhere else, which is, in our view, hopefully it would be a paving allocation if it wasn't, because it's one of the two is going to need it. So it's in that schedule. So, and then I don't know if you want me to touch on it now, but I just had a comment just related to the changes. Okay. So I just, there's three.
David, I think it's hard on FairTV unless you're like right in the mic.
Yeah, so it's new having fun thing. So, yeah, so on the changes side, I just wanted to know, I mean, this, yeah, we did sort of asterisk this a few times in preliminary and tentative and sort of called step one. I don't think we're going to come back with, you know, I certainly understand not a massive round of changes, but, you know, we are still, the new administration is, you know, one by one meeting with departments and really trying to make sure that we flesh out these projects overall. And I think that this represents a really good assessment of everything, and the finance department, Sabrina and Keelan, have a really good handle on it. But we do want to walk through you know, I've just personally asked for quite a lot of the capital plans and whatnot from a lot of the projects and really trying to get a handle on it. The timing and the escalators, I think, is a big factor. So even within this changes document, you'll notice a lot of that had to do with cash flow timing, moving from one year to another on that end, not necessarily the actual even approval. And I just want to bring that up in relation to the Dwight. So, you know, if you look right now, this is sort of our best understanding of that, you know, from a bonding perspective for seed money, right? Dwight is unlikely to make into the 25, so it would make it into the 26. The seed money for 26, I mean, these projects, even when you try to go quickly, and Dwight is probably the exact opposite of quickly, the seed money will probably then get spent over, you know, 26 and most likely miss, you know, any sort of funding for 27. So even if the appropriation just high level came in at 27, your first rounds of money coming out would probably not take place until somewhere in the 28 timeframe. And even on that end, these projects take several years, and you're not going to rush the bond out the door. In fact, you get to 28 and it's not actually even going to be that much of a number. We're not going to bond unnecessarily. So that gets into even this, you know, these top level numbers being so big. You're doing everything you can to sort of push those, even if you're moving your projects along. So it could take 3 years by the time you actually wrap that up. So, you know, that's just to give you a little background on sort of how all these pieces line up. It isn't necessarily that Dwight's not even going to get looked at until third year, things like that, right? So.
Yeah, that's helpful. I will definitely want to push off paying for it as long as possible.
Yeah, and I appreciate your questions though. So I have a suggestion. I don't know, maybe the board can tell me if this sounds okay, but so again, normally we've done this in September, and then we would have asked our questions on the projects, and then we only address questions on individual projects when they come before us for a vote, right? And that'll start happening in little pieces over the next few months. However, if there are larger items that the board wants to discuss, if you want to have a more comprehensive discussion about Dwight, we tried to do a more comprehensive discussion about Rooster River last time, but if we want to have a more comprehensive discussion about Rooster River, about WPCA, now that everyone has this and has it on paper and it's easier to look at, if anyone that wants to accumulate questions, you know, we can devote time during a meeting when we have a light agenda. You know, the beginning of April is usually a light agenda. And we can devote time to talking about specific larger projects on here. I mean, I think the smaller projects, certainly if they're under $1 million or if they're a couple $1 million, those we usually talk about when they come up for a vote. But if there are things out there in the future, like the ones I just mentioned, that people have a desire to discuss because of the dollar impact in the future or any other reason, I think that that's a good thing to do. You know, we can pull them out of an individual meeting where we'll have to discuss it and vote on it at the same time and try to get that in advance. So if anyone has those, feel free to funnel them through me, and then we can find time to get them on an agenda when they fit. So
That sounds great. Thank you.
okay. Mr. First Selectman.
So I don't really know yet how the Board of Finance wants to work capital planning, you know, but it would be great. I mean, I never, on the RTM, I used to sit in the annual, you know, meeting every once in a while. I never really liked those meetings very much because it was like, well, you're seeing this stuff in one night and then you're done and you didn't really get a chance to dig in. And I watched some of the meetings that were more frequent last year, and I didn't think they were very fruitful most of the time. But if, you know, if we get this to a point where we all feel like we're comfortable with the way this looks, I mean, we can do capital planning throughout the year because as things change, we can sort of update you as they change, so that it's sort of a rolling process, and then you don't need to do that October sprint, you know.
I think that makes sense. I think having one meeting, and I think part of this is that, look, the numbers have changed, you know, historically, you know, you'd sit there and it's supposed to be in September. You know, you look at this thing, you look at the numbers and it says, okay, 30 million a year. And you're like, okay, you know, this is a very different equation. You know, these are big numbers. There's some large projects on here. And so I think there's still a need to set aside time like we're doing tonight to understand the whole thing. Like we still haven't gotten to the waterfall, but how does this roll into the waterfall? What does this do to debt service? Like that financial picture, I think, is good to do in the capital planning meeting. But I do agree that when, you know, I'm not sure I would characterize this as a wish list. I look at these projects and most of this is stuff we've been talking about that we have to do. So if this is what it's going to be, I agree. We cannot cover this in one meeting once a year. And I do think breaking out the more significant ones, like certainly we should have a meeting about the WPCA, you know, and understand what that looks like and how hard are these numbers. And, you know, that just sets the expectation. And Dwight and, you know, the rest of, you know, Jennings, or whatever it might be, the rest of the HVAC projects. I mean, I don't know, but yeah, because we are definitely in a different world, and to the points that were made, you know, this is gonna, you know, we have to decide as a town. You know, this is gonna, for time, put pressure. I mean, we gotta pay for these projects. You know, it's gonna put pressure on our mill rate, and you know, we have to figure out what we want to do. We can't, you know, sit here year after year and complain about our crumbling infrastructure and then continue to defer these projects. We have to decide to live with crumbling infrastructure, or we're going to have to pay for this stuff. So,
well, if you live with crumbling infrastructure and then you realize when you do fix it, it's going to be twice as expensive.
Or more.
Or more.
Yeah. So, and we've learned that. So I think, you know, the magnitude of the numbers, I think we're all saying the same thing. It makes sense to do you know, we need to look at it overall, but we need to chop this up into some pieces to take a deeper dive into some of the most significant issues on here. And then this, you know, I'll call it the more routine projects, you know, we can cover as we've normally covered them. You guys may even find, I mean, you know, we've heard all sorts of things over time about the condition of our police station and our fire station. And I'm not even sure if you guys have your arms around all that, because there may be some more major things we don't know about. But, you know, we can, we can set aside time for that. And I'll just throw out, I think April, which is, we've just recovered from the budget. And I think last year we canceled our April meeting. We usually don't have much on the agenda. That might be a date to target if everyone's not too exhausted from the budget, to, do a deep dive on a couple of these things. Craig?
Yeah, thank you, Madam Chair. And I would say that I understand that we can't get into detail on all these projects at this level. For me, and I think this is consistent with how this board has handled this in years past. But to me, my objective when we review this plan is to understand big picture. What are we looking at current year, next year, over the next 10 years? What, broad strokes. We understand that the details going to change. But the bottom line number is something that we want to kind of have our arms around and understand whether that we can afford that, right? And I think part of the analysis that's in our backup we didn't touch on yet, but you talked about, even if we did move forward with these numbers that are much larger than what we've looked at in years past, and certainly in recent years, we're still under that 10% threshold that we try and stay under. So to me, this discussion's about what can we afford, big picture, and then every member of this board at one point or another asks, when a capital project actually comes to this board, ask the question, is this project on the waterfall? If so, how does this number that you're presenting for approval tonight, authorization tonight, compare to what's on the waterfall? Did it change? Why is it $4 million instead of $2 million? And so every time we have those numbers where we're actually talking about authorizing or approving a specific project, it brings into question the credibility of this plan. So I think time will tell as these projects actually come forward, how it compares to this number. Because if we constantly keep missing, and the actual project costs are going to continue to be over what's in here, it causes us to look back at this and say, wait a minute, now can we really afford it? But I think we can reserve those discussions on a per project basis for the point in time when we're actually approving them. Big picture, we need to know, generally, you've got 20 projects on your radar for fiscal year 2025, and it's going to total roughly $60 million once we take into consideration the backlog. So,
yeah, and that's why for me, I think the coding system is going to be important, because in the outer years, for example, like something like Dwight, hey, we got that by looking in the paper. There's a report of another school built in Trumbull or in Western, whatever, and say, okay, we're using that, and then we're going to escalate it. Like, that's not that might be the best we can do for now, but it will get better once we start hiring, consultants.
Great. All right. So to the affordability question, and so Matt doesn't have to sit here all night either. Let's turn to the waterfall. So for members of the public, oh gosh, I'm not sure. This is page. So for board members on your printed copies, it follows the last page of the sort of the changes sheet, and it starts with general fund and sewer only. 241 for members of the public, 241 of the PDF. And who's going to take us through this? Bill, do you want to?
I mean, I'm really looking at the percentages, on the right. And
can I maybe I'll just ask one thing. One big change here, although we sort of did this last time, but it's a little bit different now, and maybe Matt can help us here. I just want to make sure the board is focused on the fact that we have two waterfalls here, one for the general fund and one for the WPCA, and how that works, how the numbers feed into these models, and how these are kind of viewed from a rating agency perspective. So, Matt, we talked about this a little bit. Do you want to kick us off?
Sure, no problem. There was a lot of things you mentioned just there. So what I'll try to do first is just really quickly walk us through sort of the inputs and how this thing kind of works in concert with the document that we were given, from with all the capital projects. So basically we took everything that's in there and assumed in the year that the cash flows are theoretically needed, that's when we're going to do the bond issue for that project. And it aggregates to the general fund only page there is the first one, and the WPCA is the second. You have the listing of all the bond issues, and it's kind of in that middle area with the yellow with the interest rates and things like that. And you just basically pull that from there, assume that those are the bond issues, assume the 20-year equal principal repayment structure. Again, no notes. We're saying we're bonding everything, which, and I'll just caveat here is a disclaimer that the fact that there's infinite variables here, and not just a couple, there's infinite. You can't even count them. So I just want to put that out there, but based on the current plan, this is the run of bond issues for the next 10 years for the town, which is about 413 million. And then you have the WPCA is about 81. So in I guess it's in the fiscal 30 is where the WPCA now switches over and becomes a responsibility of the town. So that's kind of a new little caveat. And all the numbers that run through the general fund obviously doesn't include the WPCA. And it looks at the town budget specifically, which is separate than the WPCA budget. And then it feeds those ratios to the far right, which seem to have always been kind of a focal point for the town with respect to debt service as a percentage of the budget. So like I said, there's assumptions for interest rates. There's all kinds of things that are going to happen with these projects. In reality, there's going to probably be note components and different things. But if you kind of feed it all across the two letter, I have 8 by 14 here, so 28 inches worth of paper. It brings us to those final numbers, which there's also a couple of charts and things back there that has the debt service to budget, and just so it shows you visually the amortization of the debt service, for the next 20, 30 years. So that's sort of how the model works. I think it is about as fine-tuned as it's ever been, which is great. Again, with the fact that there is a lot of variables that goes into these things, but that's, I think, part of what you asked, Lori. And is there anything with the rating agencies? Okay, I could just go right into that. With the rating agencies, it's one of their questions is always about the 5-year CIP, because that's sort of the standard CIP that everyone puts in their documents. And we always reference the fact that we have this waterfall model that tries to incorporate a much longer time horizon and lots of different variables. And if for them, it's really more just to show that the town is really using a planning tool that is kind of above and beyond sort of the average town, which kind of makes sense when you're looking at some of these and the scale of some of these projects. So it's definitely adds value to the conversation. It's not something that immediately impacts anything rating related. It's not to say, wow, they're going to, these numbers are big, you're going to get downgraded. None of that. It's just more a tool. They understand it's a tool, and it gives them some indication of what to expect in the future, rather than on the call when they say, what are you expecting the bond in the next 2-3 years? That's the standard question. This gives them a much fuller question, a much more robust answer. So, that's kind of what it does. We can obviously look at those ratios to budget and kind of see where that compares relative to the other AAAs and things like that. But we don't really peak until 33, and so much can happen between now and then. But again, it just kind of provides a tool, for mill rate impacts too, in terms of like budgetary impacts and things like that. And
I think this and the spreadsheets are fine, but I think these bar charts are valuable. They're easy to look at, and this is on page 244 of the PDF. I don't think this is not printed on the big paper, but I don't know if we could put it up on the screen, but it was for board. Yeah, no. So it says so page page 244 of the PDF, and it says Town of Fairfield, general fund debt service to budget. It just gives the visual where you can kind of see, we still have our old line in there at 8.45%. I think that should probably go away. I think we're benchmarking to our policy of 10, but, I think that's helpful to look at because you can kind of see what these bonding levels would do to our debt over time. In the 2033, which is the peak that Matt referred to, we're at, if all these other assumptions were right, and I think some of them, particularly the budget growth numbers, are maybe a little bit conservative, so that would push these percentages down. But below 10 with this plan that we're calling a wish list. Yeah, Mr. Curley.
Thank you, Madam Chair. And I agree, the graphic representation on that blue bar chart, it helped me get my arms around the issue, and I was comforted to see that we're staying under 10%, the board's policy. But I appreciate the comments about how this may or may not impact our rating and how rating agencies will look at it, lots of other factors, I get it. But Mr. First Selectman, you had talked at the beginning earlier about it's really more potentially the mill rate and the debt service in the as it flows through to the operating budget. And Matt, I just want to make sure I'm understanding the previous page, so page 243 of our package. So it's almost the I think it's column PP of your very wide spreadsheet, where I think in the first row, which is the current year, it shows 23.666. I think that's the total debt service for the year. And that would potentially peak at just over 43 million. I can't scroll back to see, it's probably about 10 years out. So that's the number that I think that's the rubber that hits the road, right? Because you're talking about potentially increasing the debt service in the operating budget by $20 million. 10 years from now, we're going to grow to that. But that's really where it matters. I just want to make sure I'm understanding that correctly. Okay, thank you.
Yeah, Mr. Mottola?
I mean, this is all, the issue for me, it's not going to affect our AAA bond rating if we do the things we've been doing in the past. It's can we afford to do these things? It's a tax issue, basically, period.
Yep.
We haven't even ever come close the last 10 years or so to 10%. Some of us have said we should have done more the last few years when interest rates were lower, but we haven't. So that's the issue here, taxes,
And we were under 7%.
real low.
Yeah, I mean, I think, I think this question of affordability, I mean, affordability is what does that mean? That's a judgment, right? Some people said, well, we can't afford Penfield because we don't, well, you can afford it if you think it has value, right? And so people thought it had value and we voted for it, right? So it's a question of, if we don't think this is affordable in the sense that the boards, the communities don't want to approve these things because they don't think they have value, then those are decisions that we make, and then, the numbers are lower. I do want to reiterate what Matt said. I mean, the assumptions in here, who the heck knows what's going to happen to interest rates? This model has them ratcheting up a little bit. They may go lower. This model assumes that, those numbers north of 9%, that assumes our budget only grows 2.5% a year. I think this past few years, it's grown substantially more than that. Think about the mill rate, which has been offset by grand list growth and everything else, but.
I think the expense budget grew over 3% on average over the last 4 years.
Yeah. So, so there's a lot of variables here. We may not get to 9 or close to 10, depending on how those things happen or if some of these projects stretch out. So, but, so I just want to keep that in mind. I mean, because I think, again, if affordability, I don't know what that means. If we've traditionally defined it based on a policy, which says we don't want to go over 10%. So if that's the definition we use, it's affordable. That doesn't mean that people, that doesn't necessarily mean you're going to do it, because all the projects have to stand on their own merit and people have to be willing to pay for them, and they have to be considered in terms of their effect on the overall budget. But obviously there's a cost to not doing them as well. So at least based on the definition we've given ourselves historically, yeah, they fit within there for whatever that means. Sean?
Okay, so I'm just wondering, maybe you guys can just give me context, because I'm new here, but this, I guess if we back up to, or no, we go to 244. So what is the what's the magic 8.45%? I mean, where does that, if your policy is 10%?
I think that's an old graph. Yeah.
Okay.
Isn't it?
Yeah, I think Ms. Kupchak put that as a target, and I think she came up with that as that was the number that she sort of inherited from the prior administration. They were at roughly 8.5%, and so she wanted to keep it at 8.5% so as not to have an overall impact on the mill rate. But we ended up being below that. And I think if you look at how did we get so far below it, our bonding levels stayed kind of consistent even as the town grew and our budget grew. And so, over time that drove our debt service down. And, one could view that as a positive thing because it helps the mill rate. But at the same time, we have some serious issues with these, with our infrastructure. So, Mr. Becker?
Just to a point I had mentioned earlier about even to step up in some years 600,000, some years up to 4. If you go to the year that's it's about 4 years out at around 3.1 million, from a mill rate percentage based on the current budget, would actually drive downward a little bit over time. But that is around a 1% tax increase for that load, right? So obviously it's each year, right? But you'd have to build in knowing right off the bat, or that you've got offsets. But if you look at the way the budget swings in some years on the revenue side, right? Particularly even in a moderate year from a grand list growth perspective, that covers that percentage, right? So there's a couple of different ways to kind of go through this, but that's roughly 1%. It's not as bad as you think.
Yeah, the other thing that the board may remember, it's, sometimes our debt service numbers are just, they're weirdly affected. Like we had years where we issued debt and we had these premiums, and they'd come in as these big credits to our debt service budget, and you just can't project that. We'd have $600,000, $700,000, $800,000, $1 million or something that it was getting amortized in over 3 years, and it had a big impact. So, back to Matt's point, there's a lot of variables here. So it's a tool, but it's not going to be, perfectly definitive, and you have to adjust to it going forward. Yeah. Ms. Ruggiero.
Just a quick question. When it gives our percentages on this chart, that actually is in the back up here on our page, with the 845 and the number that you referenced at 2033. At the top of the chart here, it says excludes WPCA funded bonds, which I know you mentioned is separate, but doesn't that go into the calculation, or does it not?
Into the calculation that's on this chart? Or what calculation?
To the 10%.
Oh, well, typically again, that has to do with your policy. So whatever your policy says, whatever that 10% means, I can't really speak to. Now, that being said, from a rating perspective, when bonds are self-supporting, which they would be with the WPCA at least to a point, they kind of net those out for purposes of the ratios. So that's why it's nice to have like the general fund here, and now the WPCA is over here. So this says excluding WPCA funded bonds. So there's the WPCA is funding their own bonds until, I guess, July of 28, and then it steps into the town's debt. So that this does include some of that WPCA once you get out to like 29 or so. Just want to make that clear.
Yeah, and the reason, that's a great question. Just to clarify too, the reason why it's not in here, we're measuring that debt service as a percent of the general fund budget. So the WPCA debt service is not in the general fund budget. So what's valuable about this is it really speaks to the mill rate. You know, the WPCA, when we issue debt, we issue it under the name of the town, but we usually do an MOU that says that they're going to pay the debt service and they pay their own debt service, and that gets covered by, you know, the ratepayers in that fund. So to the extent that the plan, and if you go back up to the plan, to the extent that the plan is assigning projects to the WPCA to pay for, that will be a no waterfall. And then at some point, the debt service just gets too big for them with those big projects. So it's either you don't do the projects or the town pays. And then at that point, it's now reflected in the town's percentages.
Got it, thank you.
And just to add one point is to this point, the reality for the town of Fairfield was there really wasn't hardly any WPCA debt, so it didn't make a difference. Now when you're looking at $100 million, now it's like, okay, well, let's look at, you know, how to make this as realistic as possible. So that's.
And I think that it goes without saying that some of our grand list growth is limited by whether or not we make some of these investments, WPCA being one. I mean, we can't really grow the town unless we do it, so it's high priority.
Yeah. Okay, I know we could probably spend a lot more time on this. It is 10:30. Does anybody, we have a few more agenda items to get to. Does anyone else have questions on this? Okay, well, as I said, please, if anyone has specific projects on here that they want to bring up, otherwise we can take the administration suggestions on projects, specific ones they may want to walk us through over time to have sort of a more rolling process. And we can start to do that after budget season. But thank you, Matt, for hanging out with us till 10:30. It's good to have you here. Thanks for walking us through this analysis and for everything you do for the town.
Thank you very much. Appreciate it.
All right.
Thank you, Matt.
Okay, so let's see here. Let me find where I am. We are on item 6. To hear, consider, and act upon a reallocation as recommended by the Board of Selectmen of the American Rescue Plan Act, ARPA funds per Exhibit A attached in the backup. This also requires RTM approval. Can I have a motion to hear this item? Ms. Ruggiero, seconded by Mr. Mottola. So the materials for this item are on page 249 of the posted backup. So before we get into a discussion, is there any public comment on this item? Hello, welcome. Can you, sorry to keep you so late, can you state your name and address for the record, please?
It's okay, it was part of my education. So good evening, everyone. My name is Dick Mahusky and I live on Colonial Drive. I'm Secretary of the Flood and Erosion Control Board. And I'd like to call your attention to item 7 on the ARPA project list. Based on conversations with the town, we were of the impression that the $376,860 would remain available on the ARPA list, but now be directed to producing a new master flood, erosion, and climate resiliency plan for the entire town. This would include all shore areas, as well as the inland river basins, Rooster, Mill, and Sasko Creek. Our board is at the final edit of a scope of work for this project. Our timeline calls for the RFP to go out in February and March, with responses due by late March. We then expect the contract would be issued in April. Preliminary plans will be discussed in meetings with town entities and the public to elicit feedback during July and August. The final report would be issued in December 2024. This would satisfy the time constraints on ARPA funds. So we ask that you please restore the funds to this replacement priority project. Thank you.
Thank you very much. Okay. So, Mr. Gerber, I'm not sure if are you going to walk us through this?
I mean, I can start. This was very much a group effort.
Okay, and if you want to address the comments while you're walking through it, that would be great. Thank you.
Absolutely. So, big picture is, when this list of projects was put forth how many years ago? 3 years ago? 4 years ago? There were many items on this that weren't really like shovel ready, but they I'm sure made sense at the time. I was on the RTM. Nothing looked crazy, but over time, I think, and where we are now is we're coming up on a deadline of December 31st to encumber funds, which means for these projects, we would need to define the scope, go out to bid, review the bids, and then, hire the consultants. So we went through this, and I saw a lot of risk in some of these projects, so that's really one category of reallocations that I wanted to make. Another one was where I thought they weren't projects per se, but they were buckets of money that were ideas but hadn't been fleshed out, and I don't have my hands around them yet. And I'd say one of them is like DEI. So I'm committed. Like and to answer Mr. Maskey's question, like that, I've already named resiliency as one of my 5 most important things that I want to address during this term. But it's not okay to move forward unless we really know what we actually want to do, and we're not just going to spend money because we have it available here in ARPA, because if it's something worth doing. And what I did, I responded to the chair of the Flood and Erosion Control Board. I'm committed to resiliency. I think the project, as we discussed when they came and met with me, has not been nearly fleshed out yet, and we have other resiliency issues going on. One of them is Rooster River. So if you're going to look at Rooster River, we haven't even gotten comments back on a major project in the Rooster River Basin that we don't know if it's even viable yet. So we have several projects going on right now on resiliency, and we need to get a better picture of what a consultant actually be looking at. So I'm committed to doing it. We're going to have to find the funds because it's it's important for a lot of reasons. It's important for our grand list. It's important for our ecology to do a resiliency master plan. But that may be a much larger project. I'm not sure that this amount of funds will actually cover what we necessarily need to do. I'm not sure that anyone knows yet, and from the discussions I've had, I'm not sure that anyone really has a sense of it yet. For DEI, again, extremely committed to DEI, but the way forward on that was very unclear. So, I'm committed to forming a task force on racial equity and justice, and get a better sense of how we're going to move forward with making, increasing inclusivity in our government, in our society. But I'm not going to go out and just give somebody money to do something if I don't have a sense for what really the collective us really thinks needs to the way forward is. So just going through some of these projects, you want to look through the last 2 columns. The last column shows where we've requested allocating money to, and the column to the left is where we're allocating money from. So we just look at those last 2 columns, and I'll skip, which is sort of it's sort of a plug because we can spend that money and more, and we know we can. And we can lock that, we can lock those funds in by the end of the year. Actually, if whatever's available, we can lock in and get and spend. But the second, then we have have projects that are complete. So the second number 2 is complete. Go down to number 4, downtown resiliency. That project has not been fleshed out enough to encumber by the end of the year. But discussing with Bill Hurley, we're leaving money in for the design for phase 1. I'm sure everyone's aware of drainage issues downtown, and this would address some of the stormwater drainage issues. But right now, we're talking about encumbering for a design phase. We're not going to be in a position to encumber for the work phase. Going down to number 7, which is what Mr. Middlesky was talking about, that was in for a high intensity wave study. From my understanding from talking to the chair of the Flood and Erosion Control Board, there's a desire to sort of think about other ways to break the intensity of waves by putting in like reefs, like they've done off Staten Island. We had a discussion. While it's an interesting study, off Staten Island, I believe the total bill is something like $100+ million, if I remember correctly. And the discussions with race engineering, it doesn't help the rise of the water, but it helps with storm surge. It helps break the waves. It doesn't seem to me like a very good use of money, because what I will is a resiliency master plan for the town that we can sort of incorporate into the POCD that gets incorporated into where we want to build and where we don't want to build. And so I'm extremely committed to that, but that is a big project. And so just going out and pushing this through because we have the money. I mean, the money's fungible. No one needs the ARPA funds. What they do is a concept that it's either valuable or it's not. And if it's valuable, we'll fund it. And I think this one has to be funded, but it doesn't have to be funded through ARPA. I don't feel comfortable right now just looking at this reward that, that we'll be in a position to necessarily get the best bang for the buck for a flood resiliency plan until we understand better what it is we actually want to look at. Number 8. This is shovel ready. So we had a lot of we've had several accidents along South Benson Road. Some people almost getting killed by people who were partying Jennings Beach in the parking lot, driving out in the middle of the night. One car, drunk kids drove into a yard, almost ran over a family, and there were multiple other.
Madam Chair, is there a point to this dissertation?
Yes, we're walking through the changes of the reallocation that we're going to vote on.
Okay, can we move forward on that? Thank you.
Yeah, we're going line by line, Jeff.
You can.
Yeah, I would like to, listen, if we're going to vote, this is something that all the boards voted on, these allocations, so I would like a brief explanation line by line personally.
Okay.
I understand we're getting into story time at 11 o'clock at night. So maybe we can move forward in this conversation. Thank you.
On, or you can drop off.
Yeah, I'd like to continue. We're going to continue.
How about that?
Go ahead, Mr. Please keep going. I'm not.
Okay, so the gate is an automatic closing gate similar to the Cascades, where it'll close. This one, Rex has already voted on 8 p.m. closing time to keep people out of the parking lot. And so Anthony Calabrese has already priced it out and we're ready to go. And he's just waiting for the approval. Perry's Green Bulkhead, Bill Hurley can talk more to this, but that was, they went out to bid. They got the bids back, and it's a lot more than expected. Some design changes that were required. So those are then, not-for-profit mental health, and the description there, self-explanatory. Julie can't use those funds. COVID recovery assistance, the 40,000 leaves, some money behind for Julie and the, committee to, that was allocating those funds to, allocate the funds that they've already committed to in the process of looking at. But, I think past COVID, that really shouldn't be, this isn't really like set up to do. So it was nice for the community, but there's really not the mission.
Did you, I think you skipped over ADA consultant sidewalks for South.
Don't have any at all. I mean, that, I don't even know what it is, but,
Okay.
I know when I talked to you, actually knew exactly it's going to be. It was an idea that came to fruition. So, I mean, those are the, so, okay, so I'm going to go back.
Playground ones, that's just projects completed.
Records.
I'm sorry, is it the same thing with the electric vehicles? That's just under budget?
Electric vehicles, what line is that?
33?
Oh, electric vehicles, we bought vehicles and we have nothing in the docket for buying more vehicles. So
Okay.
we're just not going to go.
Madam Chair, he's very difficult to hear at this point, just so you know.
I didn't.
Digitizing records, we were wasting an extraordinary amount of space in town hall. We've got a couple of rooms of boxes that we want to clear out with the people, and in the basement as well. So this is a big project. David Becker's offered to help on that project. We're going to be scanning them and filing them digitally, and that can be done. David assures me it'll be encumbered.
Where is the report now, Madam Chair? The DEI report?
The DEI report, you mean
Draft.
939?
Right, yeah.
Yeah, that was for a consultant, and that's excess money that's not going to be spent. My understanding is the Racial Equity and Justice Task Force submitted their final report that was accepted by the Board of Selectmen.
$10,000. $10,000 of that was spent on a DEI person from Sacred Heart who reviewed the Racial Equity and Justice Task Force and provided some comments in written form, and we're going to post that online.
Okay, so this is extra money that we don't need.
This is money that I'm not sure what the plan was, but it's money that I'm not willing to right now. And I'd like to go back up to something that was taken off. The list originally line 5, I moved Rooster River and into.
Yes, Madam Chair, I'm sorry, I'm having trouble hearing Mr. Gerber. Is there
pretty
a
loud
microphone?
Is it your
Yeah.
computer?
Okay, go ahead.
I wanted to move Rooster River detention out of this because that 18 months ago, Bill and others started meeting with the Army Corps of Engineers to discuss this project. We got some initial feedback. Army Corps of Engineers had an alternative they wanted to look at. It's a viable alternative. Bill and Anthony, they wanted to use, I guess, Tungus Park as a big detention area, convert into a detention area. So we used that and the space. And so we got them off of that mindset, space, and they were to move forward with this original plan, which is 2 detention areas in Fairchild Wheeler and Tungus Meadow Park. And 14 months later, we hadn't heard from them. You know, trying to get responses from the calling. Jane finally tracked. She was supposed to be living it down. She was on vacation. She said something like, she lost half her people. We've got a huge backlog. And I've been looking at 26 projects a day. I'm sorry. And then a week or two later, they took the project from this woman and moved it back to the person who was originally looking at it. We have no idea when this project is even going to come back for comments or how many comments there are. And Bill's just waiting to hear back from them. We've contacted Jim Himes' office. Jimmy Tickey, his chief of staff, is talking to Jim Himes. They're going to try to put pressure on the Army Corps of Engineers. But this will get done. It's pretty soon. And then I don't know how many comments. Like, it could be a lot, it could be none. But if it's a lot of comments, there's going to be a lot of work to do to answer the comments. Then go out to bid. Then accept the bids, and then they have to, encumber the funds before I'd say the probability of this happening is, it's probably pretty low, but, some miracle that happened. So, Selectmen like this approach, thought it was too early. In the end, we just settled on moving this amount of money back into our a couple of months, and maybe 2 months from now, if we haven't seen progress, we will move it out again because we just can't risk.
And when you say move it out, would that involve moving it to the capital plan?
Yeah, the Easter River project has got to get done. And I think everyone knows, I'm 100% committed to it. Hopefully this board would be committed to it as well. Obviously, I can't speak for you. But, so that would magical place would be to go into again, we've got places to use that. We'll give it a couple months.
Can I just ask, so if this, and let's just say you're right, and we don't get the permits back, or we can't move forward with this in a timely manner, and it goes into the capital plan, is there a placeholder for this 2.8 million in the capital plan? I didn't see it, or does that increment the dollars in the capital plan for next year?
There are some other people texting that something has gone on with the microphone.
Exactly.
Oh, that's weird.
Yeah, nothing changed, but there are a bunch of people texting that I just got some here.
Okay.
Might be my decimal. For the Easter River, it's currently not in the capital plan. It's in ARPA for now.
No, I understand, but is there, so if this Rooster River money does move to paving, is there paving that comes out of the Rooster River plan that this replaces it, or would this just be additive to the capital plan?
Rooster River would be added to paving, and then Rooster now would be added to the capital plan.
So it would be incremental to the numbers that are in the capital plan now?
Yeah, except.
I wasn't sure. There's no paving out of the capital plan if we put this Rooster River in.
Yeah, we have a paving plan, we have a sidewalk plan. They are not budgeted for credit right now fully, so we will be able to use that for, it was time to come up with a sidewalk plan that wasn't budgeted for it.
Quick question.
Okay, Mr. Matola?
So, just from a process, how would this work? Will you then, let's say 2 months from now, you don't think anything's going to happen, you're going to go back to the Board of Selectmen and they're going to vote to move it? And then it will have to come back to us in the RTM? Is that fair to say?
I think that's the only way to do it.
Yeah, I think so too, unless they gave you, authority after 2 months.
So I think there was an agreement ultimately that, after a lot of history, that we wait a couple of months and then come back and visit it.
Fair enough. All right. Thanks.
Okay, does anyone have any questions on changes to the ARPA plan? Okay. Seeing none, we can take it to a vote. All in favor of approving the allocation of ARPA funds set forth on Exhibit A, please raise your hand and say aye. Aye. Mary, I can't see you. Mary, yes. Okay. Jack, is that a yes? Okay.
Yeah.
Motion passes 8-0. Thank you. All right. So item 7 is. Okay. We're doing the pause for a moment. All microphones.
Right.
Okay, we're back. All right, so we're going to move to item 7. And item 7 is a resolution related to grants for the Rooster River Flood Mitigation Project. The full resolution is printed in the agenda. Can I have a motion to waive the reading of the resolution and hear this item? Mr. Mottola, seconded by Ms. Ruggiero. All in favor? Okay, it is unanimous. I don't see Mr. Testani, so 7-0. Okay. All right, so is there any public comment on this item? Okay.
So, Lori, I vote yes, just so you know.
Okay, all right, so make that 8-0. Okay, so seeing no public comment, we have Bill Hurley here to walk us through this item. Welcome, Mr. Hurley.
Thank you. In a nutshell, this is a urban state aid grant where it's 100% reimbursable. It's for $2.5 million. And in the interest of time, you have plenty of the backup with the actual the draft of the bond or the grant application and agreement. 14 points. And I'll just highlight that the $2.5 million would be supplemental funding towards the proposed detention basins. It would enable the town to remove sediment in the Rooster River, to improve conveyance and proper transport and disposal required for that. Implement green infrastructure where possible and economically practical. And it will allow the town to do some open space improvements at the Villa Avenue and Algonquin neighborhood detention and water quality basin. So I'm here to answer any other questions you might have.
Okay, thank you, Bill. Questions from the board? Okay. See, it's good to come on at 11 o'clock. You get off easy. Okay, all in favor, we can take this to a vote. All in favor of approving the resolution set forth in item 7, please raise your hand and say aye. Okay, it is unanimous. The item carries 8-0. Thanks, Bill.
Thank you, Lori. I just wanted to say that I was planning on staying for the ARPA and the capital plan anyway, so thank you.
All right, so we move to item 8, to hear, consider, and appoint the clerk of the Board of Finance through the period ending May 2024. Can I have a motion to hear this item? Mr. Mottola, seconded by Ms. Ruggiero. Okay, as I noted at the beginning of the meeting, this appointment is being put forth due to the resignation of our clerk and CFO, Jared Schmidt. So this appointment will extend through the remainder of Mr. Schmidt's former term. Just for the benefit of the public, the Board of Finance appoints a clerk annually pursuant to section 8.3 of the charter, which states, I'll just summarize it, which states the following. The Board of Finance shall appoint a clerk and fix the clerk's salary. We do that as part of the budget process. The clerk shall hold office at the pleasure of the Board of Finance. The clerk may be part-time. The clerk shall keep minutes of board meetings and be a custodian of its books, papers, and data related to the conduct of its business. That's 1. 2, be a certified or a licensed public accountant or otherwise have experience in the financial field. And 3, have the right to call upon all town departments, boards, commissions, committees, authorities, and officers for such information as the clerk may reasonably require in connection with the duties of the clerk and responsibilities of the Forum of Finance. I would like to take the opportunity to nominate Caitlin Bossy as clerk to fill the term through May of 2024. She and I have discussed this. We've spoken. She's willing to take it on. She clearly meets the qualifications outlined in the charter, and I think her years of experience invaluable to this board during the transition period. And I'm very grateful that she is willing to do the job if approved by the board. So can I have a second for that nomination? Mr. Mottola. Any comments or discussions from board members? Mr. Mottola.
I just want to say she doesn't look too thrilled about taking this position, but thank you for doing it anyway. Thanks.
Okay. Any other comments?
Madam Chair, can I just ask? Madam Chair?
Go ahead.
Yeah, hey, sorry. Hey, Caitlin, how are you? This is great. Obviously, we're familiar with who you are, your background. If perhaps you could just give us a short 30-second overview of what you've done for the town. Again, I think we all are, with maybe a couple of exceptions, very familiar with what you've contributed. I just think it may be worth a 30-second overview. That's A, and B, I'm happy to hear that you're willing to take on the position.
Sure. As you guys know, I've been the controller for, it's approaching 17 years, maybe 18 now. In various, I was the clerk actually years ago, under a different administration and a different kind of, it was a little bit different than it is now, but I've worked under a CFO that time. I've learned a lot. I've been an integral part of the rating calls, and I do probably the majority of the work on the annual report. I manage the day-to-day operations of the payroll department, the accounts payable department, and general ledger. I work in conjunction with the budget director and the internal auditor on various other activities and functions within the finance department. I don't know what else to say. Clearly, I've been to these meetings more than I've wanted to be here. And as you know, I do the quarterlies, so I'm here quarterly anyways. So.
No, I know you do, and I thought it would be helpful, for everyone, including obviously anyone who may watch this, to learn a little bit more about you. Speaking for myself, you were instrumental when I first came onto the board, and still are in my mind. Probably one of the most authoritative on the budget, especially in and of itself, and of the workings of town hall. I know Mr. Mottola mentioned you being thrilled. So I'm curious as to why. I'm sure you have a lot on your plate, wondered why you made the decision to take it on. And again, I'm thrilled you are. I hope you don't mind me asking.
Because Larry asked nicely.
That's great. And you were, as always, very amenable, and that's...
She did not twist my arm at all. No, I mean, I told her, I'd help out during this whole interim phase. And you guys appoint yearly in May, so it's really to kind of help you guys get through the budget cycle, really. And I'm going to be here anyways for the quarterlies, so.
Right, that's great. I thank you for doing it. I think you're great. I'm sure I've said that to you before, but I think it's a great benefit for the town and certainly for the board.
Thanks, Jack.
All right, thank you. Any other comments, discussion from board members? Any other nominations? Okay, so we will vote. All in favor of appointing Ms. Caitlin Bossy to serve as clerk of the Board of Finance through the period ending May 2024, please raise your hand and say aye. Okay, congratulations, Caitlin. It is unanimous 8-0. Congratulations, I think.
Can you bring donuts to the next meeting? Donuts to the next meeting, please?
John, that's, okay. All right, so item 9, to hear, consider, and act upon the draft minutes of December 13th, 2023, and January 29th, 2024. Can I have a motion to hear this item? Mr. Mottola, seconded by Mr. Curley. Okay, are there any comments on these minutes? Ms. Ruggiero?
Hi, yes, I'd like to make a motion to amend the minutes from January 9th. It has, they missed me. They have me down as Chris DeWitt.
That's not very nice. Okay.
Value and presence, and I am not reflected as present.
Okay, can we have a vote on that? I guess we'll vote on that. All right, that amendment passes. Any other comments on the minutes?
Yeah, Madam.
Mr. Curley?
Just one on the second page of those same minutes for January, page 3, there's just a missing 0 in section 7. It should be 6,770,000.
Okay, that's in item 6, the last line of item.
Yeah.
Subtotal in the table in item 6. Okay, so I'll second that to change the number to reflect 6,777,000. Okay, couldn't vote on that amendment? All in favor? Okay, Jack, are you good?
Yes, sorry.
Okay, all right, so that amendment is approved unanimously. Okay, I also have one item. I'd like to make a motion on the minutes of for December. The second page, item 4, relates to the transfer of funds from debt service to the remediation account. So in the third paragraph, it says the BOS approved the resolution and all 3 bodies approved the transfer of funds. That's actually not correct. The resolution had to be approved by all 3 boards, but the transfer only required approval from the Board of Finance. So I'd like to make a motion to amend the minutes to strike the words and all 3 bodies approved the transfer of funds. It is the second page of the December minutes, item 4. Strike the words and all 3 bodies approved the transfer of funds. It is only this body that approved the transfer. Am I in the right? Oh, sorry, January. Referred to the wrong minutes. January minutes, item 4, third paragraph. Okay, all right, can I have a second on that? Mr. Mottola, in favor of that amendment? Okay, that is unanimous. Okay, so any other comments on the minutes? All right, so we can vote. All in favor of approving the amended minutes of December 13th, 2023 and January 9th, 2024, please say aye, raise your hand. Okay, it is unanimous 8-0. Okay. We'll move to item 10 to hear, consider, and act on any communications. Anything from the administration? No? Any other board members? Okay, item 11, take a motion to adjourn. Mr. Mottola, seconded by Mr. Curley, all in favor? Aye.
Aye.
Right, thank you, good night, everyone.